Hi Michael, Hi Michael。 To find the bottom of the channel, they can create a parallel of this line and drag it to the low point in between or to any of these other prior lows. To find the bottom of the channel, some traders will draw all three lines, drag it to that point in between or to any of these other prior lows. To find the bottom of the channel, some traders will low this low and they'll watch how the market behaves. When the market gets down to the line, it reverse up and it try to break to the downside again and reverse up a second time, both times with bull bodies. Very strong sell-off here, but is this a strong sell-off or this or this? Much less so. This looks like a trading range through here and then a trading range through here. This is not a strong bear trend. It's a spike and channel bear trend. So very strong bear breakout and then a channel. And the channel down spent a lot of time going sideways. This bear channel probably will end up being a bear leg in a trading range or the final leg in the bear trend. Traders will look to be buying a reversal up from the bottom of the channel. And here we have a micro double bottom with two bull bars. Should you be selling at the bottom of the channel betting on a successful bear breakout? Well, only 25% of the time are you going to get a successful bear breakout below the bottom of the channel, and that's even less likely when the channel is as weak as this. Instead, traders should be looking to buy with limit orders at the bottom of the different channels. As I said, you can draw channels connecting these lows, you can draw channels with a parallel anchoring to that low, to this low. Traders will look at any of those lines and look to buy with a limit order. Experienced traders will buy with a limit order, buy more lower. Most traders should only be entering the stops either above this bull bar or above both bull bars. A micro double bottom, down, up, down, up. By the way, this is a second reversal down from the top of the channel. If we draw a line from this high to that high, the market reversed down. The bulls again tried to break above the line and failed a second time, so that is a reasonable short. Most channel breakouts fail. Should you be selling with a limit order in this particular case at the top of the channel, betting on a failed breakout? Well, this is a special case. We have a spike, pullback, channel, probably will convert into a trading range or a bull trend. I would not be selling this high, expecting the rally to fail and reverse down again, especially when you have a micro double bottom and you see this bar going up very quickly like this. I would not be selling that, betting on the top of the channel, leading to a reversal down. Context is good for a bottom, a weak bear channel, and a good reversal. And then we have a very big bull trend bar. What's going on here? Is this bear selling at the top of the channel? Of course not. It's bears giving up. Bears deciding that it's a spike and channel bottom with a good reversal. Chances are we're going to have at least a couple legs up. The bears are giving up. They're not selling here, and the bulls are buying, expecting at least two legs up. A big bull trend bar early in a possible trend. It's a give up bar. The bears are giving up, and it increases the chances that we'll get a rally, at least a bull leg in a trading range, possibly a bull trend. Most bear trends end with a failed breakout below the bottom of a channel. We broke out, it failed. We tried again to break out, and it failed the second time. I know it does not have a wedge shape. It doesn't matter. You could make it a wedge shape using this low and that low. It would have more of a wedge shape. That doesn't matter. The key point is it's a weak bear channel, probably a bear leg in what will become a trading range or a bull trend. Plus you have a micro double bottom. So the context is good for a swing up. Do not sell at the top of the channel. It's a strong bottom, good context, and you have a big bull trend bar closing near its high. And you have good follow through as well. Instead of selling, you should be buying either the close of this breakout bar or the close of the follow through bar. You can also buy pullbacks. We have a bear bar pulling back after this 2-bar breakout. Traders can buy on the stop above its high, and same with here, and same with here. You can also buy with limit orders. We have a bear II, possible failed breakout, possible low 2, low 1, low 2, but strong enough bull bars, odds are buyers below that this is a bad sell signal. So traders will place a limit order to buy at the low of that bar, and they'll get filled right there. You can draw lines. You're seeing reversals down, lower highs, lower lows. You can draw that line. For the bottom of the channel, you can always create a parallel and drag the line to one of these lows, or possibly even here to create a broad channel. You can also draw a line connecting lows on the way down. Different ways to draw channels. That's always the case. You never know which one most computers are using until you see a reversal up. Look at this bear bar. It's a very big bear bar. Not only is it a big bear bar, where is the last time the bears have had a bar that looks like this? More than 20 bars away. In fact, in the entire 50 or 60 bars of the bear trend, no bar is as strong as that bear bar. Whenever I see the biggest bear trend bar occurring 20 or more bars into the trend, what do I think is more likely? Is it the start of a new, even stronger bear trend, or is it an exhaustive end of the trend? It's more likely an exhaustive end of the trend. We're also down around a measured move based upon the height of this bull reversal, and that is a support level. Theoretically, you have a big bull bar. Theoretically, there'd be bulls buying here for a double bottom. They were not. If we break to the downside, it's basically a failed double bottom, and the market often falls for a height equal to the height of the neckline of the double bottom. So bottom should have been a second bottom. This would have been the neckline. Traders would look for a measured move up. Instead, we got a bear breakout below the potential double bottom. Traders look for a measured move down. The gap between this close and that low probably will close. It did close right here. This high went above that low. So this big bear trend bar, instead of being the acceleration of the trend into an even stronger bear trend, more likely it's an exhaustive end of the trend, which it was. Most sell climaxes, exhaustive sell climaxes, are followed by trading ranges, not by bull trends. But once you have the trading range, then the bulls can get a reversal up, which they did here. It would be unlikely for the market to fall like this and then reverse up here. It usually has to evolve into a trading range to stop the selling, and then the bulls have a chance at a reversal up. And notice where it's taking place, at the bottom of a channel. Obvious bear trend line, and then a parallel here. Or you can draw a channel line using these lows. In any case, it's a failed attempt by the bears to break below the bottom of the channel. It reversed up a little bit here, and it reversed up a lot there. Gap between the close of the big bear breakout and the low of the prior bar. And traders will buy. They'll buy the first reversal up, higher probability to buy the second reversal up. Here we have a double bottom, slightly higher low, but it's a double bottom, and a breakout from the double bottom, and this is a pullback. They'll buy that. Should you sell at the top of the channel? No, this is a pretty good reversal with two very big bull trend bars. More likely, buyers below the low of that bar. Bulls will buy the close of that bar. They'll buy the low of this bar. We've got a small triangle, 3 pushes down, bear bar, bull bar, bear bar, bull bar, bear bar. So 3 bear bars, 3 sets of bear bars. So a triangle, and you have a bull bar. Traders will buy on the stop above the high of that bull bar and get filled here. I want to move on and talk a little bit about reversals and breakout failures. Different ways to draw the bottom of this channel. In any case, if the market is reversing up from the bottom of a channel, what's the minimum target? Well, the minimum target is for the market to go at least a little bit above the top of the channel. We're reversing down from the top of the channel. Minimum target is at least a little bit below the bottom of the channel. Different ways to draw the channel. So here, maybe here. The target was reached here. We got a little bit below the bottom of the lower line. Reversing up and reversing up again. What's the minimum target? At least a little bit above the top of the channel. And the bulls reached their target there. And you can see the hesitation, some profit taking at the top of the channel. Obvious bear channel, lower highs, lower lows, and we're getting a bear breakout. However, 75% of breakouts above or below channels fail. A bull breakout here, it failed. A bear breakout here, probably going to fail. Especially when you look at this big bear bar and then a bull bar, bad follow through. Bear bar, bull bar, bad follow through. Usually the breakout fails within about 5 bars. The biggest bear bar in more than 20 bars, in fact the biggest bear bar in 70 or 80 bars, more likely an exhaustive end of the trend. Sometimes you get one more sell climax before you get the reversal. big sell climax, a consecutive sell climax, the market probably will reverse fairly soon. Gap, this close, that low, gap, this close, that low, this close, this low. All of those are probable exhaustion gaps, and the market will probably trade above all of those lows. It did over here, making this bear bar an exhaustion gap rather than a measuring gap. Traders expect this to be an exhaustive sell climax, a failed breakout below the bottom of a bear channel. They're looking to buy a reversal up. 3 pushes down, 1 and then bull bar, 2, then bull bar, and then 3. You have a bull bar here. They'll either buy above the high of this bull bar, or this bar closing on its high, they'll buy above that high, or they'll wait to buy consecutive strong bull bars, betting that it's the start of a swing up. Another bull breakout with good follow through, they'll buy that. Here we have a pullback and a bull bar, they'll buy above its high and get filled here. Here the bears tried to reverse twice, 1, 2 at the top of the channel, and it failed. Traders will buy above the high of this bull bar, betting that the trapped bears will buy back the shorts. Reversal down from the top of a channel, minimum target is a little bit below the bottom of the channel, and that target was reached. Reversal up from the bottom of the channel, minimum target a little bit above the top of the channel, and the bulls reached their target here. However, it continued up much beyond that. This is a 15-minute chart of the euro versus the yen, and the target is at least 1 pip above the top of the channel. Reversal down, we can draw a line, and then expect a reversal down here. But look at this. We're getting a bull breakout above a wedge top. It's a wedge, 1, 2, 3, and we're getting a bull breakout. In general, if you break above a logical stop area, 50-50 chance you'll get a strong trend up, 50-50 chance the breakout will fail, and you'll get a reversal down. I have the wedge drawn here, but here is a very strong rally. A lot of traders would say that the wedge began here, so this would be the first push, this would be the second push, that would be the third push. In any case, the market broke strongly above the top of the channel, but closed strongly down at the bottom of the bar. This would be the second. I have the wedge drawn here, but here is a very strong rally. A lot of traders would say that the wedge began here, so this would be the first push, this would be the second push, that would be the third push. In any case, the market broke strongly above the top of the channel, but closed strongly down at the bottom of the bar. Chances are the market is going to have at least a couple legs down. Is this one pullback 2? Very tight bear channel. It's probably the first of 2 bigger legs. So 1 pullback and then 2 or 2. Most of the time when the market tests the top or bottom of a channel, it goes beyond. It overshoots the line before it reverses. Sometimes when it tries to test a line, it reverses up before reaching the line. That is an undershoot. Here we sold off. We went down and up and then down and up. We have a micro double bottom, but it did not quite reach the line. That is an undershoot. The market cycle, you get a breakout, and then the trend weakens into a channel, and then the channel weakens and converts into a trading range, and then the market decides on the direction of the next breakout, up or down. We have a wedge channel and a strong bear breakout, 2 legs down, 1 pullback 2. You could even call this a spiking channel bear trend. Bear breakout, pullback, and then several steps down, and a bear channel, wedge bear channel. Even though it's a spike and channel bear trend, it's still a leg within a large trading range. Just like this is a strong leg up, but it ended up as simply a leg within a big trading range. This is the euro versus the dollar, a 5-minute chart. Most of the time, when the market tests a line, it goes a little bit above or a lot above before it reverses down. And this high went slightly above that line. That's called an overshoot. Examples of overshoots, I can draw a line. The market went above, reversed down. I can draw a line above. A bear trend line went above, reversed down. A bear channel line broke below, reversed up. So these are all overshoots. That is common. But sometimes you get undershoots. Here, I can draw a line, and the market reversed up without reaching the line. Here, I have a double bottom, and the market sold off strongly, but reversed up without reaching the line. That is an undershoot. A channel, it's an expanding wedge type of channel, but it's a channel. Channels usually evolve into trading ranges. So we have a very strong bull breakout, a weak channel here. It tried to get stronger, 3 pushes up, and it evolved ultimately into a trading range. Market cycle. You got a strong bull trend, and then a channel, and a weaker bull trend. We're getting higher lows and higher highs, so it's a channel. And you'd expect a downside breakout and the evolution into a trading range, which is what we got. That's what usually happens. It's easy to confuse broad channels and trading ranges because broad channels often spend a lot of time going sideways. When you look at this, is this a bear trend, a bull trend, or a trading range? It's clearly a trading range, but look more closely at it. Getting lower highs, so it's actually the early stages of a bear trend. Lower lows, so it's clearly a bear trend as well as a trading range. Now, does it matter if you call this a bear trend, a broad bear channel, or a trading range? It doesn't matter at all because you trade them the same. You're going to buy low, sell high, and scalp. You're scalping because you do not expect any leg up or down to go very far. Even though it's a bear trend, the legs down are not much different from the legs up. It's not a strong trend. It's going to have repeated reversals, and it's better to trade it that way, scalp. Whenever the market is near a prior low and starts to reverse up, especially if it's a second entry, down, up, you buy. Higher probability to buy above a bull bar here rather than above a doji bar here. You could do either one though. Strong rally, but below the prior high, maybe a trading range, maybe a channel. Traders will look to sell. Low 2 short, low 1, low 2, bear bar. Some traders will sell this. Other traders will say strong pair of bull bars here, strong bull bar here. Wait for a second entry short, which is below that bear bar, and sell there. Same here, strong rally, not high probability taking the first entry short, higher probability taking a second entry, micro double top, and a lower high. You can call it a trading range, you can call it a broad bull channel, doesn't matter. The pullbacks are deep, they last a lot of bars. Bears will be selling rallies, at least for scalps. It's also a bull channel. Breakout, pull back a lot of bars, pull back a lot of bars, but higher lows, lower highs, and converging lines. It's a spike in channel, bull trend. Clearly a trading range, but lower high and lower lows. So it's also the early stages of a broad bear channel. Every trading range has both buy and sell signals within it. Every trading range has both a bull channel and a bear channel within it. When you look at this, it's clearly a trading range. It's in breakout mode. However, you can say, wow, it's getting higher lows and it's getting higher highs. This is also a bull trend. It is a bull trend. If the market continues up here and you ask where the bull trend began, you would say here or here. So it's clearly in a bull trend. On the other hand, this low is below that low. This high right now is below that high. So it's also a bear trend. And if this continues down here below the bottom of the screen and someone asks where did the bear trend begin, you'd say right here. So at this point, it's in a bear trend and in a bull trend. And that's the case with all trading ranges. They're neutral. They have bullish properties, they have bearish properties. It's in breakout mode. Eventually one side will win. Obviously a trading range, we're going sideways. Lower high here. Clearly the early stages of a bear trend. However, you got a rally and two legs down, one pullback, two. It could be a high two pullback, high two bull flag, and a bull trend. Once the trading range goes on for 20 more bars, the probability of a bull breakout is equal to the probability of a bear breakout. All reasonable swing setups have about a 40% chance of success. I say that, but there's a 50% chance the final breakout will be up and a 50% chance the final breakout will be down. There's also a 50% chance that the first breakout attempt will fail, and only a 40% chance that any good-looking buy setup or bear setup is the start of a swing. Lower highs, lower lows, bear trend. Higher highs, higher lows, bull trend, but a trading range. And that's the case with all trading ranges. There's always both the early stages of a bull trend and the early stages of a bear trend. And anytime you have a decent signal, like a high two buy here, 40% chance it's the start of a swing up. A decent sell signal, micro double top here, lower high, decent bear bar, 40% chance it's the start of a swing down. In this particular case, the bears won. A big bear bar closing on its high, and a follow-through bar, probably a measuring gap, not an exhaustion gap. And you can see the bulls kept trying to close the gap. They keep trying to make the market go up above this low and that low to close all possible gaps. They're failing. Instead, double top bear flag. This high, that high, expecting lower prices. Trading range, bear breakout, bear follow through, probably at least a measured move down based upon the height of the trading range. Here, the market fell much more than that. Getting higher lows, getting higher highs, early phases of a bull trend. If the market broke to the upside, you say, oh, of course it broke to the upside. We're getting higher lows and higher highs. If it goes to the downside, you'll say, oh, of course it went to the downside. We're getting lower highs and lower lows. Trading range always has both an early bull trend and an early bear trend. 50% chance the bulls will win, 50% chance the bears will win. Highest probability, don't enter until you see a very strong breakout. Lower highs, lower lows, bear trend, higher lows, higher highs, bull trend. This is a close-up of up here, this yellow line, just to show that we had a higher high. This high went a little bit above that high. So this is a higher high compared to that high. It's a bull trap. It trapped traders into buying a breakout. At one point, this was a bull bar on its high, looking like it was going to successfully break to the upside. But by the end of the bar, it was a bear bar closing on its low. It was a failed breakout above the top. Bulls gave up. For whatever reason, doesn't matter. Closed below the low of the past 50 or 60 bars, and a follow-through bar, probably a measuring gap. The bulls tried to close it here, they tried to close it again here, they tried to close it again here, they could not. Several attempts to close the gap fail. You have to expect the reversal down. Traders will be selling for any reason. I began by talking about using limit orders to fade tests of channel lines, top or bottom. I then talked about how most trends begin with a breakout, even if the breakout is not that obvious. I talked about reversals and how breakouts often fail and lead to reversals. Then trading ranges and broad channels. You often cannot tell them apart because they often both coexist. Most broad channels spend a lot of time in trading ranges, and most trading ranges have broad bull and bear channels within them. And that's how I finished up talking about trading ranges containing both bull and bear trends. Every trading range, always 100% of the time, has an early bull trend and an early bear trend within it. I'm Al Brooks. Thank you for watching. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on tight channels and micro channels. I'll begin by giving you my definition of a tight channel, and then I'll move on and tell you what I mean when I talk about a micro channel. The simplest definition is that a tight channel is a channel where there's not much space between the lines. For example, look at this bull trend. The channel is fairly tight. When a channel is tight like that, it's usually a breakout on a higher time frame, and therefore traders should only trade in the direction of the trend. This is a bull trend. Traders should only look to buy. The space between the lines is not very big, and that's what I mean by a tight channel. The channel is tight. The swings are small. The pullbacks are only a bar or two, and they do not fall very far from the low of the prior bar. Here we fell a few ticks or a few pips down before the trend resumed. When a channel is tight like this, it's very difficult to make money shorting. Even with limit orders, selling at the high of the prior bar, scaling in higher, it's very difficult to make money. And it's certainly very difficult to make money trading with stops against the trend, selling below that bar, selling below either of these bars, selling below that bar. Those are all losing strategies. Traders should only be buying when there's a tight bull channel. Selling with stops in a tight bull channel, it's going to result in just repeated losses. If ever you find yourself selling with stops and losing repeatedly, you have to assume that the channel is tight. And once you make that decision, you have to be thinking about only buying. 5-minute chart, fairly tight bull channel. The pullbacks only last a few bars, do not fall very far. Here's a 30-minute chart, same thing. Same market, 30-minute chart, 5-minute chart. 30-minute chart, it's a micro channel. It's a strong breakout, a series of bull bars closing at or near their highs, certainly above the midpoints. There are some bear bars, but their lows do not go below the low of the prior bar. And the following bar does not go below the low of the bear bar, triggering any stop entry short. When a 30-minute chart looks like this, you should only buy. When a 5-minute chart looks like that, you have to assume the 30-minute chart looks like this. It's a breakout on a higher time frame, and it's better only to look to buy. Trade it like a breakout, only look to buy. It is a breakout on the next time frame up, 15-minute, 30-minute chart. I want to put into words some parameters that give you an idea of when a channel is tight. For example, look at the size of an average bar, and all of the pullbacks are less than twice the size of an average bar. The pullbacks are small. If an average bar is about 8 ticks tall, then the pullbacks are less than 16 ticks. Here is an average bar, maybe 8 ticks tall. This is the pullback. It's less than 16 ticks from that high to this low, from this high to that low, from this high to any of these lows. That is a sign that a channel is tight, and you should only be buying, not selling. Here are some pullbacks. This pullback is 19 ticks, more than twice the size of an average bar. But look at all the other pullbacks. They're all less than 16 ticks, less than twice the size of an average bar. Therefore, traders should not be selling. You can also decide whether or not a channel is tight based upon the size of the smallest scalp. In the E-mini, the smallest scalp is 4 ticks, 1 point. So if the pullbacks are all less than 8 to 12 ticks, you should assume that the channel is tight. If the pullbacks are all less than 2 to 3 times the size of the smallest scalp, the trend is tight, the channel is tight, and you should only assume that the channel is tight. If the pullbacks are all less than 2 to 3 times the size of the smallest scalp, the trend is tight, the channel is tight, and you should only look to sell. 11-tick pullback from the low to the top of the pullback, from the low to the top of the pullback, 7-tick pullback. The average pullback is not 3 times bigger than the smallest scalp, 1 point. Therefore, it's better to assume that the channel is tight, and a tight pair channel, it's a breakout on a higher time frame chart, better only to sell. In any tight channel, never trade against the trend, even with limit orders. If you buy this low and you scale in lower, it never comes back to your first entry price. The gap stays open, you lose. If you buy this low, it never gets back to your entry price. So even scaling in, you lose. So you can't even make money with limit orders, and you certainly cannot make money with stop orders if you're buying in a tight pair channel. Pullbacks are too small to make money, even with limit orders. You will lose money. Even if you win on 70% of the trades, the losers are going to be significantly bigger than the winners. You will lose money. Look at this chart of the euro versus the dollar, a 5-minute chart. All the pullbacks are less than twice the size of an average bar. If an average bar on this chart is about 10 pips tall, the pullbacks are all less than 20 pips. And that is one of the criteria I use to determine whether or not a channel is tight. When that is the case, the channel is tight. Here, the average bar is about 10 pips tall. And here's the size of the pullback, from the top of the trend to the pullback, top of the trend to the pullback, top of the trend to the bottom of the pullback. All of the pullbacks are less than twice the size of an average bar. Therefore, the pullbacks are small, the channel is tight, and traders should only look to buy. Another way to do it is base your determination on the size of the smallest scalp. In the euro versus the dollar, as in all forex markets, the smallest scalp should be 10 pips. If all of the pullbacks are less than 2 to 3 times the size of the smallest scalp, you should only trade in the direction of the trend. You should conclude that the channel is a tight bull channel and therefore do not sell. For example, if the smallest scalp is 10 pips and the pullbacks are all less than 20 or 30 pips, the channel is therefore tight. Tight channels, you only trade in the direction of the trend. This is a bull trend, a tight bull channel, you should only look to buy. This shows the size of the pullbacks, and they're all small. They're all less than 14 pips. That's less than 2 to 3 times the size of the smallest scalp. The smallest scalp is 10 pips. All of these pullbacks are less than 20 or 30 pips. Therefore, traders should only buy, do not sell. In any tight channel, bull or bear, never trade against the trend. The pullbacks are too small, so even if you're trading against the trend using limit orders, you will lose money. And that's true even if you win on 70% of your trades. The losses will be sufficiently bigger than the wins so that you will end up losing money. I want to talk a little bit about what constitutes a micro channel in contrast to a tight channel. I want to talk a little bit about different types of tight channels, some variations of tight channels. A micro channel means no pullbacks. For example, here we have 5 bars without a pullback, and then we have a pullback here. That is the end of the micro channel. Here's the micro channel. And then through here, we have a series of bars with no pullbacks, and then we have a little pullback here. This low went below that low. So this is a micro channel. And then again here, 4 bars or so, 5 bars without a pullback, another micro channel within a tight bull channel. Small pullback bull trend. This is a small pullback bull trend. The pullbacks are all small. 1 bar, very tiny pullbacks. This entire trend is a small pullback bull trend. That is a type of tight bull channel. A parabolic wedge. This is not a parabolic wedge, but a parabolic wedge is also a type of tight bull channel. And then any tight trading range is a type of micro channel, except that it's horizontal. Remember, all trading ranges are contained between 2 lines, one above, one below, and therefore all trading ranges are channels. But unlike trend channels, they're trading range channels. They're horizontal sideways channels. During these 11 bars, every low is at or above the low of the prior bar, and therefore it is a micro channel, which is a very special type of tight channel. It's a tight channel where there are no pullbacks. This bar traded below the low of that bar, and it began the micro channel. This bar traded below the low of that bar, it ended the micro channel. It's hard to see, but in fact, that bar did trade slightly below the low of that bar. Another type of tight channel is a small pullback trend. Here we have a trend, a bear trend, and the pullbacks are all small. The pullbacks last only a bar, 2 or 3, so 1 bar, maybe total of 4 bars here, but the pullbacks are not very big. On a higher time frame chart, a very tight channel like this is either a micro channel or a breakout, no pullbacks. A parabolic wedge is also a type of tight channel. We have 3 pushes up, 1 or 1, and then 2 or 2, and then 3. The wedge often does not look like a wedge shape. If I connected this high to that high, it would not look like a wedge at all. I think the way the market looks at this is 1, 2, and then 3, a failed breakout above the top of the wedge. A parabolic wedge top like this usually is climactic. Usually the third push goes above the line, connecting the first and second push. And you often get a failed breakout and then a reversal. A tight trading range, that is a type of tight channel as well, except the channel is sideways. It's not a trend channel. I could draw a line across the lows. I could draw a line across the highs, and therefore it's a channel, but it's horizontal. The market fell for 9 bars, no pullbacks. The market tried to reverse here, but this bar did not go above the high of that bar. The market tried to continue up here. This bar did not go above its high, and therefore it's a micro channel, part of a micro channel. The bears controlled the market for 9 bars. 9 bars with no high going above the high of the prior bar. That is the definition of a micro channel. The bulls are trapped in, the bears are trapped out. The best the bulls probably can hope for is a trading range, not a bull trend. We finally get a reversal. We finally get a bar that goes above the high of the prior bar. So this is a pullback in a bear micro channel. It's probably a minor reversal. It's very unlikely that a 9-bar bear micro channel is going to turn into a bull trend. Much more likely, the best the bulls get is only a trading range. Because of that, a bull trend, much more in a bear micro channel. It's probably a minor reversal. It's very unlikely that a 9-bar bear micro channel is going to turn into a bull trend. Much more likely, the best the bulls get is only a trading range. Because of that, traders will bet the bulls will fail. So they'll sell above bars. They'll sell above the high of the prior bar. They'll assume the reversal up will fail, and they'll sell below the low of the prior bar. And again here, now we have a small double top bear flag. Bears will sell below the low either of that bar or better below the low of this bar, a bear bar closing near its low, betting on resumption of the trend down. This bar led to a pullback. We have a little pullback here. And then we have 8 bars down without a pullback. This bar went above the high of that bar. So that ended the bear micro channel. 8-bar bear micro channel, a lot of selling. We have 5 bear bars closing below their midpoints, several of the bars closing on or near their lows. The bears are really eager to sell. Lots of gaps. The close of this bar at the low of that bar, the close of this bar at the low of that bar. The bears are eager to sell at low prices. The market's probably going lower. This is the dollar versus the Canadian dollar, a 15-minute chart. And look at the pullbacks. It's a small pullback bull trend. Now look at this bear bar. What follows? Is it another big bear bar? Are we getting consecutive big bear bars? No, no consecutive big bear bars. The pullback, it lasted 1 bar. Here, it lasted 2 bars. So the pullbacks are brief, only lasting 1, 2, or 3 bars. Also, here's the moving average. Most of the bars are above the moving average, and in fact, the market's above the moving average for 20 or more bars. Again here, very strong bull trend, a very tight channel. When the market looks like that, you only buy, since the pullbacks are not deep enough to make profits if you sell. When the market's in a bull trend like this, a small pullback bull trend, a very tight bull channel, the buy setups never look good enough. Yet weak bulls keep getting trapped out. They keep waiting for a big pullback. They keep hoping to buy. They want to buy a pullback, but the pullbacks just never look good enough. But a small pullback bull trend like this is a breakout on a higher time frame chart. Traders have to buy. They buy for any reason. They buy below bars. They buy bear closes. They buy above bars. They buy bull closes. You have to get long. And the correct stop is always much further away than what you want it to be. The correct stop is below the bottom of the most recent high or low. Once you determine that the market's in a small pullback bull trend like this, typically every pullback ends at a higher low. So it allows you to use a tighter stop than what you might think. If you buy here or anywhere in here, your stop is below there. And if you start going up here, your stop initially is below here, but after a few bars, you'll probably raise your stop to there. In this video, I talked about tight channels and micro channels and what parameters I use to define both. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 2 videos on tight channels and micro channels. I'm going to begin by talking about tight trading ranges, and then I'll talk about breakouts and climaxes. you look at this chart, you can see the market was in a bear trend, and then a trading range, and then the bear trend resumed. However, the height of this trading range is only 9 ticks tall. That's often enough room to scalp with limit orders, but not when the average bar is only 6 ticks tall. If the smallest scalp in the E-mini is 1 point, which it is, you should not trade when the market looks like this. You should not trade even with limit orders. It's too difficult to make money, too easy to lose money, and it's too easy for the losses to be bigger than the wins. My general rule is, if you're going to trade, you want the range to be at least 2 to 3 times taller than the smallest scalp, and 2 to 3 times the height of the average bar. The smallest scalp in the E-mini is 1 point, so you want the range to be at least 2 to 3 points tall. And if the average bar is 6 ticks tall, you want the height of the trading range to be at least 12 to 18 ticks tall, which it's not here. So traders should not trade when the market looks like that. We have a bear breakout of a triangle and a follow-through bar. The market looks like it's changing, and it looks like the bear trend is resuming. So bear trend, trading range, you can call it a triangle beginning all the way back here. We're getting higher lows, and we're getting lower highs. And we're getting a breakout with good follow-through. This close is below the low of the past 20 bars or so, closing near its low, and we have consecutive big bear bars. Odds are this is the beginning of trend resumption down. Here's a 5-minute chart of the euro market, and you can see we're sideways here. In fact, we're sideways all the way here, and then we got a bull breakout and a second leg up. Take a look at the height of this range. The range lasted about 5 hours, and the height of the range, top to bottom, was only 14 pips. The average bar was only about 3 pips tall for about 5 hours. When that's the case, you should not take a trade. In the forex markets, the smallest scalp is 10 pips, and when the range is this tight, you should not trade even with limit orders because you will not make money. My general rule is I want the height of the range to be at least 2 to 3 times bigger than the smallest scalp size, and I want the height of the range to be at least 2 to 3 times taller than the height of the average bar. Here, the average bar is maybe 3 or so pips tall. Here, maybe 4 or 5 pips tall. The entire range is only 14 pips. That is barely 2 to 3 times the height of the average bar. But I also want the height of the range to be at least 2 to 3 times bigger than the smallest scalp. The smallest scalp is 10 pips. I need the range to be at least 20 to 30 pips tall to scalp even with limit orders. Otherwise, do not trade. Too easy to lose money. We got a breakout here, a bear breakout here, follow through here. This close is above the high of the past 20 or 30 bars, maybe the high of the past 50 bars. And then we have a bull body for follow through, either by this close, by the close of the follow through bar, or even by the low of this bar with the limit order, expecting the start of some kind of a trend up. Strong bull breakout, bars closing on their highs. Bears are giving up, bulls are buying closes. It's a buy the close bull trend. You have to buy. Here we have a micro channel. We have a bar, another bar that did not trade below its low, another bar that did not trade below its low, another bar that did not trade below the low of the prior bar. So this is a 4-bar bull micro channel. This bar traded below the low of that bar. So this is the end of the bull micro channel. Micro channel can be simply 2 bars. It can be 10 bars. It can be 50 bars. This one is a 4-bar bull micro channel. Once you get a pullback, it's no longer a micro channel. It's still a tight channel, which is still a sign of strong bulls. Chances are the first reversal down will be followed by another leg up. But now I'm going to be talking specifically about micro trend lines and micro channels. When you have a micro channel like this and you're starting to draw a trend line connecting the lows of this bar with that bar, that's horizontal. Or this bar, and then this bar, or that bar. It's a very tight channel. Most of the bars touch the line. Most of the bars are close to the line, and the bars are often very small, as they are here. Here we have 2 bars without a pullback, 3, 4, 5, 6 bars. This is a 6-bar bear micro channel. No high went above the high of the prior bar until this bar. That ended the micro channel. It's about a 50% pullback, not quite. It's a bull flag. 2 legs down, 1, and then bull bar, and then 2. Traders will buy on the resumption up. Here we have 2 bars, 3 bars, 4 bars without a pullback, and we finally break above the trend line here. So this is a 4-bar bear micro channel. And then here another bear micro channel. We have a breakout above the high of that bar, so that ends that micro channel. And then a 3-bar micro channel. And then here about a 10-bar micro channel. And here a 4-bar micro channel. This bar going above the high of the prior bar ends the channel. 3-bar micro channel, 4-bar micro channel, and 4-bar micro channel. So lots of micro channels. most of the bars touch the trend line or are close to the trend line. The bars usually are small, but sometimes they can be relatively big, like here. And here are a number of bull microchannels. So 4 bars up, and then a pullback. That ends that channel. And then we got another 4-bar bull microchannel here. Here we have about a 7 or 8-bar bull microchannel. The purpose of drawing lines like this is it highlights strong legs, whether the market's in a trading range, a bull flag, a bear flag, or a strong trend. It's a channel, and therefore it's a trend. It's a small trend. Even this, a 2-bar sell-off, you can call it a 2-bar bear microchannel or 2-bar bear trend, but it's not as big or strong as the bull trend that preceded it. So it was a 2-bar bull flag. When you have a bull microchannel like this, and the bull bars are fairly strong, closing on the high, big bull body, a break above a bear channel, you can call it a wedge bottom, traders will look to buy the first reversal down. They can buy with a limit order at the low of that bar, or they can buy with a stop above the high of this bar, expecting at least one more small leg up. Bear microchannel, good-looking bear bars here and here. Bears will sell the first reversal up, expecting at least a little bit more down. They can sell with a limit order above the high of that bar, or with a stop order below this bar or that bar. Microchannel, you need 2 lines. I typically only draw one. A lot of times if the microchannel is just a few bars, I don't draw a line at all. I just have it in my head. I'm just aware of the microchannel. We're in a bear trend, so we have a micro trend line, a bear trend line that only covers a few bars, 2 to 10 bars. The market's in a bear channel, so you can always draw a second line. Here, you would draw it there. You can call it a wedge if you want. It's a channel that is converging. The lines are getting closer together. Here we have a bull trend line below, and a bull trend channel line above. The channel line really adds nothing to what you're seeing, and you don't have to draw it. I virtually never draw it. I'm only interested in the trend line. Bear trend, so bear trend line. Bull trend, so bull trend line. The first reversal down below a pretty strong bull trend, probably buyers below, so I'm looking to buy. Even this, pretty strong bull trend, first reversal down, bulls will probably buy, but the correct stop is below the bottom of the bull breakout or the bottom of the bull trend. And you can see that if you bought that low and used the correct stop, you would have gotten out break even, or you could have bought more above a bull bar here or over here. You'd make money on the second buy and get out break even on the first buy. 1, 2, 3, 4, 5, 6 bars without a pullback. We finally have a pullback. So it's a 6-bar bull microchannel, and it has a couple pretty strong bull bars. Chances are traders will buy the first reversal down. And this becomes a bull flag. 3 pushes down, 1, 2, and then 3. This is a 5-minute E-mini strong bull breakout and a bull microchannel. The bull channel has 6 bars before having a pullback. Bull trend line. Bulls will buy the low of that bar, betting that the bear reversal attempt will fail, and the market will go up at least enough to make a scalp. Once you see a strong microchannel beginning, a lot of traders will flip to a smaller time frame chart, like a 1-minute chart or a 2-minute chart. You might find an earlier entry on a smaller time frame chart. Most traders who are starting out should not be doing that. This is the 1-minute chart of exactly this chart. This blue box is exactly this blue box. 1-minute chart, 5-minute chart. 1-minute chart, 5 times more bars. This is the 5-minute entry. And if you're looking at the 1-minute chart, this is where you'd get filled if you took the entry on the 5-minute chart. However, on the 1-minute chart, there's also a bull microchannel. We have 7 bars here without a pullback and pretty good looking bull bars. So some traders will buy below the low of this bar, betting the bear reversal will fail. Others will buy on a stop above the high of this bar. That would be an example. They would enter there on the reversal attempt below the bull trend line, betting that the reversal attempt will fail. The entry price on the 5-minute chart is 20.9875, which is right there. This is the 5-minute entry. If you instead entered on the 1-minute chart, you entered here on the first attempt to reverse down or on the resumption up from this bull flag. The entry price on the 1-minute chart right here is 20.9725. It's 6 ticks less than the entry on the 5-minute chart. Here we have a 6-bar bear microchannel. This is the first reversal up above the high of the prior bar. So that is a breakout above the bear microchannel, the bear trend line. Bears can sell at the high of this bar. They get filled over here, or they can sell on the resumption down. This becomes a bear flag, and they sell the breakout below the bear flag, and they get filled here, just below the low of that bar. They bet the bulls will fail. They can look at a smaller time frame chart to see if they can find an earlier entry. This is a 1-minute chart of that. This blue box on the 5-minute chart. This is the same bars on the 1-minute chart. There are 5 times more bars. Here's where the bears sold on the 5-minute chart, and this is that entry. If you look at the 1-minute chart, this is exactly when you would have gotten short. However, you could look at the 1-minute chart and say, pretty good bear microchannel here, falling about 6 bars with a couple good bull bars. Why not simply sell at the high of this bar, betting that the bull reversal will fail? That is okay to do. Here, the sell on the 5-minute chart was at 1.1304. And the 1-minute traders sold right here. And they sold 4 pips better than the ones who took the 5-minute entry over here. Again, most traders should not do this. They should simply stick with one time frame. However, if you're able to do it and you're able to make quick decisions and you're eager to get in, one way to get in is to look at the 1-minute chart. So if this is falling and you're saying, gosh, I'm hoping for a pullback so I can sell at the high of the prior bar, you can put up a 1-minute chart and see if there's a micro channel on that chart as well, and then sell at the higher bar on the 1-minute chart instead of waiting for the pullback on the 5-minute chart. We have a strong rally here. We have 6 bars closing near their highs, and a very big bull bar here. So a 6-bar bull microchannel. The bears are attempting to reverse, but when a trend is this strong and you have a breakout this big, the odds are they'll be at least a little bit more up. Because of that, bulls will buy at the low of this bar, betting that the bear reversal will fail. Remember, bulls were buying at the high of all of these bars, so they're buying at the close of all of these bars, certainly above the low of the prior bar. Now they're finally getting a chance to buy at the low of the prior bar. A lot of bulls will take it, and they'll get filled right there. When you have a strong trend like this, you should not be thinking about selling. You're not going to make money. The best the bears can hope to see after a strong breakout like this is a trading range. And here the trading range just lasts a couple of bars. You're not going to make money selling. Here we have about 7 consecutive bear bars and maybe a 9-bar bear microchannel. Is this reversal up going to be successful? Probably not. Most of these bear bars close at or near their lows and certainly below their midpoints. That's a sign of good selling pressure. And even with a good bull bar like this, the odds are the bull reversal will be minor and that there'll be more sellers at the high of that bar. Because of that, traders, as this market's going down, will place limit orders to sell at the high of the prior bar. Did not get filled, did not get filled. Finally, they got filled, looking for at least a small second leg down. Strong bear trend, do not look to buy. The best the bulls can hope for is maybe a trading range, which they got over here. And you're not going to make money even with limit orders when the range is that tight. Only sell. We have a bull trend, a wedge bull trend. Bull bar, bear, bull, bear, bull, bear. So 3 pushes up, 3 reversals down. And then we have 4 consecutive bear bars closing on their lows with decent sized bear bodies. This is a breakout, and it's early in a trend. It's more likely to lead to a measured move down than it is to be an exhaustion gap followed by a reversal back up. And we have a breakout here, and then a pullback here and here did not close the gap between these highs and that low. Therefore, we might get a measured move down based upon the height of this strong bear breakout. This is the measured move, and look what happened when we got down to that measured move target. Lots of gaps between the low of this bar and the close of this bar, the close of that bar, the close of this bar, the close of this bar. So at this point, the gap is this close and that low. And at this point, the gap is this high and that low, or this high and that low, and the gaps did not close. The gap between this close and that low, or this low, lots of gaps in here. The bulls tried to reverse and close those gaps, could not. And then we started to go down. So you have to assume that this series of gaps will result in a measured move down. And this breakout will be a measuring gap. I call it a gap, even though there are many different ways to draw the gaps. You can simply call it a strong breakout, and you can call this the gap. Pullback, breakout point, probably a measuring gap here for a measured move down. A similar strong bear breakout, here about 8 bars down, several closing on their lows, but it's occurring 20 or more bars into a trend. When you have a bear breakout 20 or more bars into the trend, and that breakout is the strongest that the bear trend has been, the odds are that it's going to be an exhaustion gap rather than a measuring gap. It can be a measuring gap, but a strong bear breakout late in a bear trend, more likely a sign of exhaustion and usually followed by a trading range instead of a measured move down. A microchannel, it's a breakout on a higher time frame chart. It certainly is a breakout. Gap, you can say the close of this bar with the low of that bar, the close of this bar with any of these lows, the close of this bar with the low of that bar, the beginning of the microchannel, the close of this bar and that low. Those are all different ways to look at this in terms of a gap. All of those little gaps eventually closed. And at some point, when it gets above this low, traders will start calling this an exhaustive move. When it gets all the way back here, where the bulls first began to buy at the low of the prior bar, you can say that the whole thing is an exhaustive move, especially once you get above the high of the bar. This is a major lower high that led to a strong breakout and a new low. Once the market gets above it, the argument that this is a bear trend is over. The market then is either in a trading range or in a bull trend. I'm going to talk a little bit now about whether a breakout is the start of a move or a climactic end of a move. Here, we have no pullbacks. This low is above that low, and that continued on for about 10 bars or so. So it's a microchannel. Here we have a lot of bars in the microchannel, and a lot of the bars are very big, closing on their highs, with not much overlap between the bars. Is this more likely to be an exhaustive end of a bull trend, or is it more likely to be a breakout that leads to a measured move? If you have a lot of bars and big bars, the buy climax is more extreme. Remember, every bull trend bar is a breakout. Every bull trend bar is a climax. Every series of bull trend bars is a breakout. Every series of bull trend bars is a climax. I view this pair of bars as a buy climax. Then we have a pause. Then we have another buy climax here, and then a pause. And then another buy climax up here. So it's a series of consecutive buy climaxes without a pullback. More likely, you'll get exhausted bulls, and you'll get a pullback that lasts more bars. Typically, I look for a pullback lasting about 10 bars and having at least 2 legs. And the pullback can be sideways or down. Here, 2 legs sideways, 1 pullback, 2. So we have a 2-legged pullback, became a triangle. 11-bar bull microchannel, consecutive buy climaxes 1, 2, and 3. Many big bars. Expect at least 10 bars, 2 legs, sideways to down, and a pullback. So this would be the minimum that traders would expect. It's an exhaustive buy climax. We have a bull microchannel here, lasting about 8 or 9 bars. All good bars, many closing on their highs, most closing above their midpoints. And this is a breakout. Every bull bar, every series of bull bars is a breakout. Now we have a bear microchannel with 5 bars without a pullback. This bar went above the high of that bar. So this is the end of the bear microchannel. It's 2 legs down, 1 pullback, 2, around a 50% correction of the bull trend. It's a bull flag. It's also a bear trend, but what's more likely? Is it going to be a bear trend that continues down indefinitely, or are we going to get trend resumption up? Most reversal attempts fail, and the bears are trying to reverse this bull trend, probably will fail. The bulls are trying to reverse this bear trend. Probably will fail as well, so we may go sideways here. Which is stronger, this or that? This clearly is stronger. This looks like a two-legged pullback in the bull trend. And look at this bear bar and the follow-through bar, bad follow-through. We have a pair of bear bars, bad follow-through. Bear bar, bad follow-through. Bull bar, good follow-through, good follow-through, good follow-through. So a much stronger rally than the sell-off. This bear breakout probably is a bull flag and not the start of a bear trend. Again, a 5-bar bear microchannel, pretty strong. First reversal up might not get far, so we might get a second leg down. However, this is still probably a pullback in this bull trend and not the start of a bear trend. If you buy, you have to allow for the possibility of at least a little bit more down after a 5-bar bear microchannel. So as you stop here, I don't think so. I think your stop is either below the bottom of the buy climax or down here, below the bottom of the bull trend. In general, buying above a bear bar, even in a bull flag, is not a good bet. You can see we tried to get another leg down. Had you put your stop below this bull bar, you would have been stopped out. Had you used an appropriate stop down here or here, you would have been successful. Had you been stopped out by the market going below this bar, if your stop was there, you'd buy again above this bull bar, and you would have caught that swing up. Second entry buy. So if you did not buy above this bear bar, you could buy above this bar. It would be a higher probability buy. We have a bull breakout above a bear microchannel, a new low, and resumption up. On a smaller time frame chart, this would actually be a lower low major trend reversal. Let's say this is a 5-minute chart. If you looked at a 1-minute chart, you'd see a bear trend, a bull breakout, and then a lower low major trend reversal. On this chart, it's simply a bear trend and then a micro double bottom, a lower low micro double bottom, with a good looking bull bar after a good looking bull bar, and around the 50% pullback of the bull trend. We have a bear breakout that lasts about 10 bars. It's a microchannel. Every high is at or below the high of the prior bar. That's a sign of strong bears. And a microchannel is a breakout. If not on this chart, then certainly on a higher time frame chart. We have a 4-bar bull microchannel here, 4-bar bull microchannel here. These are attempts to reverse the bear trend. But when a bear trend is in a very tight bear channel like this, every one of these bull reversal attempts will probably be a bear flag, a bear breakout, and lower prices. Most reversals fail, so traders should assume that the bull reversal attempts will become bear flags and that the bear trend will resume. It's a low 1 sell setup here. We had a low 1 here, and then it became a low 2. Traders will sell below that bar or below this bar, and they'll sell below that bar and below this bar or that bar, expecting the bull reversals to fail, even though they're bull microchannels. A 4-bar bull microchannel, and the same here, but minor compared to the size of the bear trend. Here, 5-bar bull microchannel, 2 pretty strong bull bars. Chances are the first reversal down will fail. Traders betting on the reversal could buy with a limit order at the low of the prior bar. Here we have about a 10-bar bear microchannel. Traders assume the first reversal up will fail, so some traders will place a limit order to sell at the high of the prior bar, even though it's a micro double bottom, up, and a higher low. It would not have this 8, 9, 10-bar bear microchannel if the bulls were all that strong, so traders will sell. Here, it looks like a pullback, but there's no pullback. This low did not fall below that low. This low did not fall below that low. The bull microchannel extends from here to here, where the first pullback was. Traders expect the first reversal down to fail. They'll buy with a limit order at the low of that bar. They'll be filled here, and they get a little bit more up. If you're looking to sell, do I want to sell this? No, the first breakout below a bull microchannel probably will fail. If I'm looking to sell, maybe I'll take a second entry, especially since we have a good bear bar here, and the market went below it, triggering that short. And then we have a second bear bar here, market went below it, triggering that short. This is a higher probability short than that. This is probably a buy. This is a sell. On the reversal up, we tried to bottom here, a decent looking bull bar, and we have a micro double bottom, down, up, it failed. And now we have a consecutive bottom attempt. This is a higher probability buy. Here's the first break below a bull microchannel, it failed. And then we have another small bull microchannel. This is a second attempt down. Higher probability of success, also a decent looking bear bar. Also, the entire screen looks like a trading range. And when the market is near the bottom of a trading range, bulls like to buy second reversals up. When the market's near the top of the trading range, bears like to sell second reversals down. 3 pushes up, and then a pretty strong bear microchannel. We fell for about 8 bars without a pullback. Strong bear breakout, especially these 4 bear bars. Probably the first reversal up will fail. It could be a strong enough breakout to result in a bear trend. It turned out that it was. You have to sell for any reason. A bull breakout above the bear microchannel probably will fail, so you can sell above the prior bar. You can sell below this bar, low 1 bear flag. After the third bar closing on or near its low, you can start to sell closes there, and you can sell bull closes as well, betting that reversal attempts will fail. We're getting a series of bull bars here. Higher low, major trend reversal. Bear trend, bull breakout, higher low, head and shoulders bottom, left shoulder, head, right shoulder. Here, we're getting 3 bull bars, and then a doji bar, 4, 5, 6, 7 bull bars. This is probably strong enough so that we'll get at least a small second leg up. Therefore, the first bear break below the bull trend line will probably fail, and bulls will look to buy the reversal down, betting that it will become a bull flag instead of a bear trend. Traders will buy for any reason. They'll buy at the low of the prior bar. This is then a 2-bar bear microchannel. It's a bull flag. Bulls will buy above the high of the prior bar, betting that the breakout of the bull flag will go up high enough for a profit. And after the third, fourth, or fifth close, traders will buy closes. Here they'll buy bull closes. the first bear bar, they'll buy the bear close, betting that the bear reversal attempt will fail. Look at this. This bar did not pull below that bar's low. We did not get a pullback until up here. This is an 18-bar bull microchannel. Will traders buy that low? Well, they might, right? First pullback. However, this 3 bull bars, big bars closing on their highs, you have an unusually strong bull breakout late in a bull trend. It increases the chances that this is an exhaustive buy climax and the end of a trend. This is the start of the day. Here's the end of yesterday. 18 bars without a pullback over 2 days. Let's say a bull started buying closes, and let's say they bought this close. Obviously, it's buy the close here, it's buy the close here, and it's buy the close here. The bulls who bought that close would be disappointed to see this bear bar and this bear bar. A lot of bulls will then place a limit order to get out break even at the first entry. They bought here, they'll place a limit order to get out break even here. And look what took place on this bar. It went a little bit above that close, and the bar then sold off. That tells you that a lot of bulls use this little rally to get out break even. They're no longer willing to be long at this price. The bulls are selling, and that resulted in a reversal down. Big bear bar closing on its low after 3 bear bars, totally reversing this bar, or almost totally reversing it. This big bear bar is the final bulls giving up. The bulls who bought that close, or any of these closes, held for a bar or 2 or 3, and then decided after 3 bear bars, 4 bear bars, it's not worth being long, and they gave up, hoping to buy again lower. The market's always in short. Bull microchannel, good bull bar, series of bull bars. This is the euro versus the dollar, 5-minute chart. A 7-bar bull microchannel. This bar traded below that bar's low, so the bull microchannel began here, but the bull trend, the tight bull channel, began here. This strong bull microchannel is occurring late in a bull trend. Maybe this is 20 bars into the bull trend. When you get a very strong breakout, we have a breakout here, and then a 4-bar breakout here. When you get a strong breakout occurring 20 or more bars into a trend, it's more likely an exhaustive end of the trend than it is the start of a new, stronger trend. Exhaustion does not mean reversal into a bear trend. It simply means the bulls don't want to buy, and you get a pause or a reversal. We have a 1-bar pullback. Bulls will buy this low, even though it's a bear bar. Some bulls will buy that high, and they're happy at the close of this bar. But what happens with the close of this bar? The bulls are giving up. They're deciding that the market's not going to go higher. That will probably pull back 5, 10 bars or more. A micro double top. The bulls quickly gave up. They quickly decided that it's not worth being long. And this reversal down is the start of that give up process. The bulls selling out of their longs and the bears selling into shorts. After 3 or 4 consecutive bear bars closing near their lows, bulls will sell and bears will begin to sell as well, expecting at least a small second leg down. You can call this a spike and channel bull trend. We have a bull breakout, a big bull bar, and then a parabolic channel. If I drew lines across the highs, you can see the lines are getting more and more vertical. So spike and channel, or you can call it a spike and a parabolic channel bull trend. Usually when you have a spike pullback channel, the market comes down and tests near the bottom of the channel, which it did here. We have a breakout point here. This bull bar broke out above that high, and the breakout point finally got tested over here. At this point, we have a gap, this high, that low. The bears tried to close the gap here, could not. But 80 bars later or so, the bears finally got below the breakout point, and then this gap closed, and this became an exhaustion gap. A fairly good sell climax. We have 5 consecutive bear bars, much stronger bear trend than this. Trend resumption, breakout, trading range, trend resumption down. And it's a bear microchannel. This high is above that high. This is the start of the bear microchannel, and it lasted about 5 bars. That's a breakout, and when you get a breakout occurring 20 more bars into a bear trend, that breakout is more likely going to be an exhaustive move, an exhaustion gap, than it is the start of a stronger new bear trend. Should you sell the high of this bar? You can, but only if you can use a wide stop, maybe up here, and are willing to scale in higher. However, when you get a sell climax late in a bear trend, usually better not to take the sell. Wait 5 or 10 bars and see if the bulls can reverse. In this video, I began by talking about tight trading ranges, and then I talked about breakouts late in trends and trying to determine whether they will lead to a new leg in the breakout or will they be an exhaustive end of the trend. I'm Al Brooks. This is the second of 2 videos on tight channels and micro channels. Thank you for watching the Brooks Trading Course. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on trading ranges. I'll begin by distinguishing a pullback from a trading range. A pullback is simply a small trading range, and the trend is likely to resume. A trading range is a pullback that has grown to so many bars that it's not clear whether the trend will resume or reverse. Next, I'll talk about the 2 hallmarks of a trading range: confusion and disappointment. Whenever you look at a chart and you feel confused or disappointed about the follow-through after a move, you have to assume that the market's in a trading range, even if it does not yet look like it's a trading range. Why did institutions create markets? The goal of the markets is to maximize trading. They want to make it easy to trade at a reasonable price. This is a 1-minute chart to illustrate a point. The market's going down and down more, but look what's happening to the volume as it's going down. As it's probing for a fair price, fewer and fewer trades are taking place. That means fewer traders are willing to sell at this low price. All markets are constantly in search of the best price, a fair price. And that usually means a price where trading volume will be maximum and the maximum number of trades will take place. So not just big volume, but big trades, lots of trades. And the market usually has to go too far to find out how far enough is. And then it tends to oscillate around the fair price. New information is constantly coming into the market, and eventually the market decides that the price is wrong and that it's either too high or too low, and it then has to probe in search of another fair price. I want to talk a little bit more about this volume. The market's falling, it's getting cheaper, yet fewer trades are taking place. If it's getting cheaper, bulls will want to buy more. The price is getting lower, and bulls always want to buy when the market is getting cheap. How can volume be going down if there are more and more bulls wanting to buy? It's going down because there has to be bears willing to sell for a trade to take place. If the trading is getting less and less and less as price is going down, that means bears are no longer willing to sell at that price. The price is too low, and the market has to go higher to find sellers. I want to be clear, I'm not recommending that you look at volume. I'm using volume here to illustrate a point. In fact, I think most traders should not look at volume. It's a distraction. However, it does illustrate a point. Trading was drying up, big volume, another big bear breakout, but fewer trades taking place. The market had to go higher to find traders willing to sell. Remember, the goal of every market is to find an area of agreement between buyers and sellers, between bulls and bears. And that's the reason why most bars on charts are in trading ranges, or channels which become trading ranges. Only about 5 to 10% of the bars on any chart are in a strong breakout. 90% of the bars on every chart are either in a channel, which evolves into a trading range and is the beginning of a trading range, or in a trading range. That's because the market perceives a trading range as a range where price is most fair. And since the purpose of markets is to find an area of agreement between bulls and bears, price tends to oscillate around a fair price. In this particular example, you can see most of the bars are within a trading range. As I said, on any chart, only about 5 to 10% of the bars are clearly in a breakout. Only 5 to 10% of the time does the market clearly believe the price is wrong, and the market quickly finds a more fair price, a trading range. Here is a strong bull trend, but even when the market's in a strong bull trend, there are periods of two-sided trading. As bulls see the market go higher and higher, their stop is still down here or down here. It's becoming further and further away. That means their risk is greater, and at some point they have to reduce that risk. The easiest way to do it is to take profits, and that's what happens here. You start to get pullbacks when the bulls are concerned that their risk is too great and maybe there's not that much left to the upside. They reduce their position sizes. Obvious stop at the bottom of the bull breakout or below the bottom of the entire bull trend. And that profit taking creates pauses in the trend. Eventually the pullbacks get deeper and deeper and deeper as bulls become less willing to buy high. They'll only buy deeper pullbacks, believing that the market is evolving into a trading range. The more it becomes a trading range, the more bulls only want to buy low. Every pullback is a trading range, but a small trading range. As long as traders believe the trend is probably going to resume, I use the term pullback. If the pullback grows to 10, 20, 30 bars, then the trend becomes further and further to the left. It has less influence on the market, and eventually the direction of the breakout becomes unclear. It becomes equally likely that the breakout will be to the upside as it is that it will be to the downside. At that point, I use the term trading range. Pullback when you think the trend will resume, trading range when it's no longer clear. Any area of two-sided trading is a trading range, even if it's only a single bar. It's common to see pauses in trends that last only one bar. For example, here, the market went up strongly and then it hesitated. On a smaller time frame chart, this is a trading range if you get to a smaller time frame chart. For example, if this is a daily chart, on a 5-minute chart, this is probably a trading range day. It's a pullback on this chart, but it's a trading range on a smaller time frame chart. Remember, I think of every pullback as a small trading range, but a special type of trading range in which the trend is likely to continue. I only use the term trading range when I believe the bulls and bears have become balanced. For example, a little pullback after 3 bull bars, probably going higher. 3 bear bars, but about a 50% pullback of this rally, the trend probably will continue. Here, more bars in the pullback, it's less certain that the trend will continue. Strong bull trend, a pullback, still more likely to go up. But we have a bear breakout below the bull flag, and the bulls are giving up here. And bear trends usually begin with bear breakouts, and we got a spike and then pullback, double top bear flag, and a channel down. Bull trend over here, bull breakout, pause, the trend resumed. Does this look strong enough to make traders believe the market will reverse this bull breakout? No, I would call it a pullback in this breakout because I believe the odds are the market's going higher. The same with right here, probably going at least a little higher. Same thing in a bear trend. Maybe this is a bear trend, maybe it's a bear leg in a trading range. I think this does not look strong enough to reverse that, so the bears are hoping this is a bear flag. It turned out to be. Strong bear breakout, good follow through, trying to reverse up, not looking good for the bulls. This is a small pullback. It grew into a larger pullback. Is it a trading range yet? I would not use the term at that point. I still think the odds are the bears are more likely to get a bear breakout, so I would still call this a pullback. Double top bear flag, first high, second high. Same with here, probably going lower. Here, it's probably going lower, becoming less likely. Maybe you can start calling it a small trading range. Very strong bull breakout and good follow through. We have some bear bars here. It's a 10-bar trading range. However, do you think it's more likely that the bull trend will resume or more likely that it will reverse into a bear trend? Most traders would look at this and say, it's still more likely to go higher, and therefore I would use the term pullback rather than trading range. You can call it a trading range. It is a trading range. Every pullback is a trading range. But as long as I believe the trend is going to resume, I usually use the term pullback. Strong bear trend, pullback, probably going to resume down. Even though this pullback is about 15 or 20 bars, the bulls have not done enough to create a major reversal, and therefore the odds still slightly favor the bear breakout. You could say the trading range lasted all the way to here, so more than 20 bars, getting close to 50-50 chance the bulls will get a reversal. However, I still believe the odds are more likely that the bears will get the bear breakout. Even when a pullback goes 20 or 30 bars, I still think the odds slightly favor the trend that preceded it. Here we have a pullback that grew to 20 or 30 bars. It's close to 50-50. Probably a little bit higher for the bears, maybe 51 or 52%. The trend will resume down, maybe 48-49%. It will reverse up. Now we have another pullback, still a bear trend, pullback more than 20 bars. At this point, I would start using the term trading range. We have a potential final bear flag here, breakout, pretty good rally here, a lot of bull bars here. This is probably neutral at this point. 50-50 chance the bears will get another leg down, 50-50 chance the bulls will get a major trend reversal. Here, a higher low, major trend reversal. Bear trend, bull breakout, couple legs down, good looking buy signal bar, higher low, major trend reversal. Remember, the more bars that get added to the trading range, the more distant the bear trend becomes, the less influence it has on the direction of the breakout. And at some point, after 20, 30, 40 bars, the probability for the bull breakout, the reversal, becomes almost as high as the probability for a resumption of the bear trend. Bear breakout, 4 consecutive bear bars, but look at the bodies. 1, 2, 3, 4. They're getting smaller, and here became a doji. Bear breakout here, followed by a strong bull reversal. The bears are losing control, and it's clearly neutral, not yet bullish until you see these 2 or 3 bull bars. Big up, big down, big confusion usually results in a trading range. And once a pullback grows to 20, 30, 40, 50, 60 bars, it's becoming increasingly balanced. And the prior bull and bear trend, in this particular case, there's a bull trend and a bear trend. At this point, they're so far to the left that they've lost influence. And the market is a 50-50 market, 50% chance bull breakout, 50% chance bear breakout. If one side clearly had higher probability, the market would not be doing this. For example, if everyone looked at this and thought the probability was the market would go higher, it would be going higher. If they thought the market was going to go lower, it would be going lower. The only way it can stay like this is because traders cannot determine whether it's more likely to break to the upside or to the downside. 2 important hallmarks of a trading range are confusion and disappointment. And if you feel either, the market probably is in a trading range, even if it's not obvious at the moment. Trading ranges can be very difficult to trade. There's always confusion at the start of the legs. It's rarely certain that a reversal has begun. So for example, is this going to go up far enough for a trade? What about this? What about this? What about this? Signal bars and setups are usually weak. The trends are weak. They reverse. The pullbacks from the trends are often deep. Bull trend, but big reversal to a higher low. It's a pullback, but it's very deep. Usually when you have a trend with a very deep pullback, in this case up and then down, big down, big confusion, usually leads to a trading range. Here we have big down and big up, usually leads to a trading range. Signal bars are often weak. You want to be buying after 5 consecutive bear bars, one of them closing on its high. Here you have a doji bar, does not look like a strong buy signal. Here you get a bull bar, but following a very big bear bar with a follow-through bar, not a convincing buy. And you want to be selling this after 3 strong bull bars. Here you got a high 2, high 1, high 2, but a bear bar. Do you buy this? Well, what about this? It fell below that low. Also, trading ranges tend to spend a lot of time in the middle. Here, we're spending a lot of bars in the middle of this range. We got to break out to a new low, and then this whole thing becomes a bigger range. And then look at this, we're spending a lot of time in the middle third. Bad follow through after strong trend bars and breakouts. Good bull bars, bad follow through. Good bull bars, bad follow through. Strong bear bar, bad follow through. Good bull breakout bars, bad follow through. That's very common. You're constantly disappointed and confused. Every time the market looks like it's about to break out, it reverses. Setups that look like they should be low probability, in fact, are closer to 50% probability. Things that look bad are not as bad. This looks like a low probability buy, yet it did that. This is not a particularly high probability buy, neither is this. But bulls buying above the high of those signal bars still were able to make scalps. On the other hand, setups that look like they should have high probability, 60% probability, also have closer to 50% probability. Rather than a normal breakout or channel market where probability is usually often 40% or 60% low probability or high probability, in a trading range, probabilities tend to gravitate to around 50-50. Nothing is as bad as it looks, and nothing is as good as it looks. Looks like a bad buy, yet went up. Does not look like a very good sell, yet went down. Looks like a strong bull breakout, but look what followed. So it was not a high probability. That looked like a very good, bad as it looked, or 60% closer to 50. On the other hand, setups that look like they should have high probability, 60% probability, like a low setups that look like about to break out, it reverses. Setups that look like they should be low probability, in fact, fact, are closer to 50% probability. Things that look bad are not as bad. This looks like a low probability buy, yet it did that. This is not a particularly high probability buy, neither is this. But bulls buying above the high of those signal bars still were able to make scalps. On the other hand, setups that look like they should have high probability, 60% probability, also have closer to 50%. Breakout bars, bad follow through. That's very common. You're constantly disappointed and confused. Every time the market looks like it's about to break out, it reverses. Setups that look like they should be low probability, in fact, are closer to 50% probability. Things that look bad are not as bad. This looks like a low probability buy, yet it did that. This is not a particularly high probability buy, neither is this. But bulls buying above the high of those signal bars still were able to make scalps. On the other hand, setups that look like they should have high probability, 60% probability, also have closer to 50% probability. Rather than a normal breakout or channel market where probability is usually often 40% or 60% low probability or high probability, in a trading range, probabilities tend to gravitate to around 50-50. Nothing is as bad as it looks, and nothing is as good as it looks. Looks like a bad buy, yet went up. Does not look like a very good sell, yet went down. Looks like a strong bull breakout, but look what followed. So it was not a high probability that the market was going to continue higher. Disappointment. Just when you think the market looks like it's about to break out, you get a reversal. Strong bear breakout, it reverses up. Even stronger bull breakout to a new high, it reverses down. Bad follow through, constant disappointment. If you see that, you know that you're in a trading range. Second leg traps, first leg up, pull back, second leg, and instead of this leading to a breakout, it led to a reversal. The market often looks strongest right before it reverses. Here's a small second leg trap, one, pull back, two, and instead of continuing up, it reversed down. Here, small second leg trap, leg one, pull back, two, instead of continuing down, it reversed up, and then a large second leg trap, one, pull back, two. Gaps and negative gaps, they usually close. Bulls have a little negative gap here, should go up, and eventually close, it soon close. Bulls trying to get a gap here, and it closed. Bulls trying to get a gap here, breakout test, strong bull breakout, testing this high, it closed. Bears have a bear breakout here, the gap closed. Bulls get a breakout here, gap between this high and all of these lows, and eventually it closed. So disappointment, gaps closing all the time, bad follow through after strong breakouts up and down. In a trading range, my 80% rule, 80% of breakout attempts fail, no matter how strong they look. Very strong reversal up and good follow through. Odds are buyers below, but at some point you have to conclude there are not enough buyers below to get a second leg up after this strong bull breakout. Strong bear breakout, and what happens? The market reverses. The bull's trying to break to the upside again here and here, reverses. Bear's trying to get a breakout here and again here, it reverses. 4 consecutive bear bars, reverses up. Like all markets, trading ranges resist change. Trends, they resist reversing. 80% of the reversal attempts in a trend fail and become flags, and the trend continues. In a trading range, 80% of the breakout attempts, the market trying to become a trend, those breakout attempts fail, and the trading range continues. Traders are constantly disappointed by follow-through. Very strong pair of bull bars, and look at this. If you're a bull and you bought that close, what are you thinking? You're disappointed. If you're a bear, thinking that this might be a measuring gap, and then you see the follow-through bar, disappointment. When you see that, when you see bad follow-through after strong trend bars, you're disappointed. That is the second hallmark of a trading range. The first one is confusion. Strong breakout, bad follow-through. Strong bear breakout, bad follow-through. Strong bull bar, bad follow-through. Strong bull bar, bad follow-through. Strong bull bar, bad follow-through. When you see what appears to be a bull trend, yet the bull bars have bad follow-through, the bull trend is probably a bull leg and what will end up as a trading range. Here we're trying to continue up, but look at the follow-through. Where are the consecutive big bull trend bars? We had some early on, but not here. Here we had bad follow-through after every strong breakout. Here we don't even have breakouts. This is probably a bull channel that will become a trading range. Strong breakouts up and down, but the gaps soon close. This closed below the low of that bar and below the low of these bars, but look what happened. It closed. Strong breakout far below the low of that bar. The close is far below that bar. Gaps with all of these lows, yet look what happened in the next few bars. Every one of the gaps closed. Strong breakouts, creating gaps, but the gaps close. Pullbacks usually go below breakout points. For example, here we have a breakout, but look at the pullback. It fell below the breakout point. Here, a strong bear breakout. And what happened? The pullback came back above the breakout point. Bull breakout quickly came back below the breakout point and even reversed down. Another sign of a trading range. Possibly an early bear swing. But because of all the trading range price action, traders will assume that this bear breakout will pull back above the breakout point, which it did. We have a bull swing and an attempt at a bear reversal, but it turns out it was just a deep pullback from this rally. Pullbacks are deep, so the market makes a big move up, gets a deep pullback down. The market makes a big move down, gets a deep pullback up. Again, the bear is trying to turn the market down, but look at the size of this pullback. It retraced most of that bear breakout. Every trend is really simply a leg within the trading range and not a trend. Bull trend, yes, but really a bull leg in a trading range. Bear trend, yes, but really simply a bear leg in the trading range. Remember, any pause in a trend and you look at it and you believe the trend will continue, that pause is a pullback. It's a small trading range. Again, I use the word trading range if the pullback has grown to so many bars that it's unclear whether the trend will continue or reverse. Here we have a pause, a pair of inside bars, an II pattern. This bar is inside that bar, and this bar is inside that bar. Its high is at or below that high. Its low is at or above that low. Bull trend, a pullback. It's some profit taking by the bulls. It's also an attempt by the bears to reverse the trend. When you look at this pullback, you say, wow, those bears are so strong, this reversal is going to succeed. Or do you look at that and say, wow, that's not much by the bears, chances are the trend is going to resume. Obviously, the trend is likely to resume, and therefore this small trading range is a pullback, it's a bull flag. You're confident that the trend will resume. The odds are very high that it will continue at least a little bit higher. On the other hand, if you see a pullback and you're not really certain whether the trend will resume or reverse, I use the term trading range instead of pullback. For example, at this point, do you think the bull trend will resume, or do you think this might be a higher high major trend reversal and the start of a bear trend? You don't know. It's pretty much 50-50. At that point, I would start using the term trading range, and I look to the left to determine where the range began. Maybe it began here, maybe it began here. Remember, every channel is usually the beginning of a trading range, even though it's still part of the trend. Trends transition. You have strong bull breakout, and then a channel. The channel is usually a transition into a trading range. So it's part of the bull trend, but it's also part of the trading range. Trading range on the 5-minute chart here, the bulls and bears are balanced. The bulls try to get head and shoulders bottom, left shoulder, head, right shoulder. Breakout, but not all that far. And the bears see a double top bear flag, and the bears won. If you look at the 60-minute chart, all of this is simply a pullback on the 60-minute chart and a strong bear trend. So on the 60-minute chart, this reversal attempt is probably going to fail, and the bear trend will probably resume down. On the 5-minute chart, that's not the case. It looks pretty balanced, bulls and bears. At this point, a swing up is probably equally likely as a swing down if you're looking at the 5-minute chart. However, this bull swing, Even though the market's always in long on the 5-minute chart, it's simply a pullback on the 60-minute chart. The bear trend on the 60-minute chart is therefore likely to resume. Here's a 5-minute chart of the euro versus the dollar, and you have a bull trend and then a trading range lasting maybe 30 or 40 bars. Initially, the odds favor the bulls, but every bar that gets added to the range makes the probability closer and closer to 50-50. The bears see a head and shoulders top, left shoulder, head, right shoulder. The bulls see a nested wedge bull flag, 1, 2, 3, or 1, 2, or 3. If you look at a 60-minute chart of the same thing, this 2 hours of sideways to down trading is simply a pullback on the 60-minute chart. When you look at the 60-minute chart, this does not look like it's strong enough to reverse this 4 big bull bars. On the 60-minute chart, this 2 hours of sideways to down trading is a bull flag. On the 5-minute chart, it's not as clear, and the probability is almost as high that the bears will succeed as it is that the bulls will get their trend resumption. In general, it's better just to trade one chart. If you're a day trader, you're probably trading the 5-minute chart, and you're not worried about the 60-minute chart. You trade the pattern in front of you. 60-minute chart, clearly the odds are the market will resume up. But if you're day trading on the 5-minute chart, a lot of times a bull flag on the 60-minute chart, bears can make money selling on the 5-minute chart. Those swings are often big enough down so that the bears can make money on the 5-minute chart. Small trading range, the market probably resuming up, I would call it a pullback. Even this, probably resuming up, so I would call this small trading range a pullback as well. When that's the case, when you believe the market is going to continue up, it's usually better only to trade in the direction of the trend, in this case, buy. On the other hand, this pullback grew to 30 or 40 bars, and it's not as clear if the trend will resume or reverse. And this range is very tight. Traders probably are better off not trading. Here, we have a pullback. Is it a reversal? I don't know. We went to a new high. It's confusing. Big up, big down, probable trading range. Big down, big up, probable trading range. And you could say this whole thing is a trading range. Once it becomes unclear whether the trend is going to resume or reverse, traders stop using the term pullback and instead refer to the pattern as a trading range. In a trading range, there are always reasonable buy and sell setups. The bears see a lower high major trend reversal. The bulls see a double bottom bull flag. The bears see maybe a wedge, 1, 2, 3, or a double top, and the bulls see a double bottom or a double bottom here. A bull trend needs higher lows and higher highs. And bulls look to put their stops below major higher lows. Is this a major higher low? Well, I like to see two things. I like to see a strong breakout and preferably to a new high. So this is not clearly a major lower high. This falling below that is not enough to make me conclude the bull trend has ended. However, this is a strong bull breakout to a new high. If the market falls below this, it's probably no longer a bull trend. This did not fall below that. So you can argue this is still part of a broad bull channel forming higher highs and higher lows. Here we have another very strong bull breakout to a new high. So this then becomes the major higher low. If the market falls below this, then traders will conclude the bull trend has ended and the market has either become a bear trend or a trading range. And it did fall below that low at this point. A major higher low, another major higher low. Finally, the bears broke below major higher lows. That ends the bull trend. At this point, no more bull trend. It's either a trading range or a bear trend. We fell below this low, but this is a minor higher low. And therefore, falling below it does not change the opinion of the bulls. They still believe the bull trend is up and it's just having a deeper pullback. Where is the major higher low for these bulls? Well, it's probably down here or down here. These bulls are still bullish as long as it stays above this low or that low. Obviously, if it breaks strongly to the downside and does not reach those lows, the bulls will conclude the bull trend has ended. But if it simply kind of drifts down but stays above the major higher lows, it's still a bull trend. Here we have a bull trend, second leg up, and we're starting to get small bars, a lot of small bars, and the pullback just seems to be endless. When that happens, the prior bull trend loses influence. The further the bull trend gets to the left, the less effect it has on the market. The breakout becomes equally likely in either direction. Again, the bulls see a double bottom bull flag, and the bears see head and shoulders top or a wedge top, and then a lower high major trend reversal. Whenever you look at a chart and you see a good argument for the bulls and for the bears, you know you're in a trading range. I stop using the term pullback and I start to say trading range. Equally likely that you'll get a bull breakout as it is that you'll get a bear breakout. What's the minimum for a trading range? Usually 3 legs and 20 bars. We have a leg down. It's still a pullback in a bull trend. It's still above this major higher low. Usually 3 legs and 20 bars. We have a leg down. It's still a pullback in a bull trend. It's still above this major higher low. Then we have a leg up, a resumption of the bull trend, a bull channel, higher lows, higher highs. And as soon as you see the third leg down, and if it falls below a major higher low, this barely did, then you have to be thinking that we have the minimum ingredients for a trading range. 3 legs, 1, 2, 3, and we fell below the bottom of a major higher low. This is probably a more important higher low. I mean, it clearly is a more important higher low, but this, I think, is increasing the likelihood that the market is in a trading range. I would conclude that it's in a trading range at this point. The bears need a lot of bars to create doubt in the minds of the bulls. And once they do have enough bars, 3 bear bars, 4 bars here, 3 here, and then about 8 or 10 consecutive bear bars here. Once the bears have created enough doubt in the minds of the bulls here, 3 here, the likelihood that the market is in a trading range, I would conclude that it's in a trading range at this point. The bears need a lot of bars to create doubt in the minds of the bulls. And once they do have enough bars, 3 bear bars, 4 bars here, 3 here, and then about 8 or 10 consecutive bear bars here. Once the bears have created enough doubt in the minds of the bulls about the continuation of the bull trend, the market's in a trading range. And there's equal chance that the bull trend will resume up as there is that it will reverse down. Equally good reasons to buy and sell. Remember, a trading range always has to have both buy and sell setups. They have to be equally good so that you're not sure if the bulls or bears will win. In other words, it's confusing, and confusion is one of the hallmarks of a trading range. Bad follow through after each leg, a strong bull leg, bad follow. Follow through and strong bear leg. Bad follow through for the bears. As the range grows, new buy and sell setups form. Old ones don't work and they evolve into new ones. I began this video distinguishing a pullback from a trading range. A pullback is a small trading range in which the trend probably will continue. Once the pullback adds enough bars so that it's unclear whether the trend will continue or reverse, I use the term trading range. If ever you look at any chart and you're confused about what's going on, or you're disappointed after a strong move up or down, you have to assume that the market is in a trading range. And if it is, you trade it like a trading range. You buy low, you sell high, you scalp. I'm Al Brooks. This is the first of 6 videos on trading ranges. Thank you for watching the Brooks Trading Course. This is Al Brooks. Thank you for watching. watching the Brooks Trading course. This is the second of 6 videos on trading ranges. I'll begin by talking about how every trading range always contains both buy and sell setups, and the setups are reasonable. I'll move on and talk about breakout mode. The trading range has a 50% chance in general of a bull breakout and a 50% chance of a bear breakout. And finally, I'll talk about second leg traps. Trading ranges are always trying to break out into a trend. There's often a first leg that's not particularly strong, and then a pullback, and then a very strong second leg, and it looks like the start of a trend. However, it very often is a trap, and I refer to that as a second leg trap. And those traps usually reverse and go to the opposite side of the trading range. Take a look at this chart. Clearly in a trading range, you can say the trading range began over here, but let's just use this part of it right here to illustrate a point. Every trading range, always 100% of the time, has both a reasonable buy setup and a reasonable sell setup. And whenever you look at a chart and there's both a reasonable reason to buy and a reasonable reason to sell, you know the market's in a trading range. My 80% and those traps usually reverse and go to the opposite side of the trading range. Take a look at this chart. Clearly in a trading range, you can say the trading range began over here, but let's just use this part of it right here to illustrate a point. Every trading range, always 100% of the time, has both a reasonable buy setup and a reasonable sell setup. And whenever you look at a chart and there's both a reasonable reason to buy and a reasonable reason to sell, you know the market's in a trading range. My 80% rule, 80% of the time, the trading range breakout attempts will fail and the trading range will continue. We tried to reverse down, we tried to break to the upside, we tried to reverse down from a double top or a higher high. We tried to break to the upside, tried to break to the downside, tried to go up to the upside again. Finally, it appears that the market might be breaking to the downside. 80% of breakout attempts, no matter how strong they look, will fail when the market's in a trading range. We have a bull trend and then a trading range, and every trading range in a bull trend has both a double bottom of some kind, and the bulls hope that the double bottom bull flag will result in a bull breakout and a resumption of the bull trend. And every trading range has some kind of a major trend reversal. Here we have a lower high major trend reversal, and it's also a head and shoulders top, left shoulder, head, right shoulder. Here's a trading range in a bear trend. And every trading range, whether it's in a bull trend or a bear trend, will have both a reasonable sell setup and a reasonable buy setup. We have a double top bear flag, a slightly higher high double top bear flag, and then a smaller double top for the second of the two tops, but basically a double top bear flag. And the bulls see a double bottom, higher low, major trend reversal. Bear trend, bull breakout, higher low, not enough bars for a major reversal, so we got a minor reversal. Now we have a double bottom and plenty of bars for a major reversal, so a double bottom, higher low, major trend reversal. 50% chance there will be a successful bull breakout and a reversal of the bear trend, 50% chance there'll be a successful bear breakout and a resumption of the bear trend. I say that, but unless the setup is especially strong, I think the prior trend still has a slightly higher probability of resumption than reversal. Another feature of trading ranges is the top and bottom are never all that clear. Every trading range eventually breaks out into a trend, and there's about a 50% chance of a bull breakout and a 50% chance of a bear breakout. In addition, there's a 50% chance that the first breakout attempt will fail. It'll reverse. Again, my 80% rule, 80% of breakout attempts will fail. the market has inertia, and it continues to do what it has been doing for a long, long time. Because 80% of the breakout attempts up or down fail, traders look to buy low, sell high, and scalp. You scalp because you assume the market is not going to break out. 80% of the breakout attempts fail, so you have a better chance to make money by taking quick profits. Beginners are naturally hopeful that a strong move near the bottom will result in a bear trend, a strong rally at the top will result in a bull trend, and they end up buying high. They see strong bars near the top. Here we have 5 bars without a bear body, and they think that because we've broken above all the bars to the left, this is the start of a bull trend. And here they now see 7 consecutive bull bars, and they think, wow, this is really gaining strength. It's going to become a bull trend, and they end up buying at the top. And at the bottom, they'll see 5 or 6 consecutive bear bars, and then another breakout with a follow-through bar, and they assume that the bear trend will be successful. But with all the trading range price action to the left, the odds are all of these breakout attempts will fail. Beginners end up buying at the top and selling at the bottom, which is the exact opposite of what the experts are doing. A lot of traders have a good sense of where the approximate top and bottom of the range is, and they're confident enough that the breakout attempts will fail, so that they begin to buy as the market is in the buy zone near the bottom, and they begin to sell when the market is near the top in the sell zone. They use wide stops and they scale in, confident that the breakout attempts will fail and the market will reverse and they'll make a profit. Again, experienced traders are confident that no matter how strong a breakout looks, it's going to fail and the market will reverse. Another strong breakout attempt, reverse. Strong bull breakout attempts at the top, and they reverse down. Because traders know that the breakouts are unlikely, they're also going to be taking quick profits. They tend to scalp when the market's in a trading range. For example, a lot of trading range price action here. We're trying to get a bull breakout, maybe strong enough for a second leg down. Maybe this is the end of the second leg. Maybe we get a double bottom. Some bulls will buy here, use a wide stop, and look to scale in lower. Another breakout below this double bottom. The bulls are confident it will not get very far. Some bulls will buy more above this good-looking bull bar. Other bulls will hold on to their original position. If the second entry is less than a scalp distance away from this entry, a lot of traders will not add to their position. On the other hand, if the second entry is bigger than the size of a scalp, a lot of them will add on, and then they'll get out break even on their first entry or on the entire trade. Others will take the second entry and just hold and look for some kind of top in the top half of the trading range, and then they'll exit. When you're in the top half, top third of the trading range, traders begin to look for reasons to sell. A break above this high probably will fail, probably will not get far. Some bears will sell here. Others will wait for a strong bear bar and then sell below the low. Here it's a second entry short. Down, this bar fell below that bar, triggering a first entry short. You can argue a wedge, 1, 2, 3, or 1, 2, 3. With 4 or 5 bull bars up here, a lot of traders would prefer a second entry short and to sell below a bear bar, so they might sell here. And their stop might be here. They might use a wider stop to allow for the possibility of one more minor high before they get a swing down. A lot of traders, when the market's in a trading range, expect every breakout attempt to come back above the breakout point. They'll place a buy limit order to buy at that low, and they'll get filled here. And then they'll place additional limit orders to buy lower. In general, it's better to take a second entry if it's at least the size of a scalp below. And then if the market gets back to your original entry price, you make a scalp profit on your second price, and you can get out break even on your first. Or if the context is good, you might try to get a scalp on your first entry as well. Again, new low. A lot of bulls will place a buy limit order to buy at the most recent low, so they'll buy here. And if it falls for the size of a scalp or 2 times the size of a scalp, they'll buy more lower. Others will wait for the reversal up and buy above this bull reversal bar. These are examples of limit order buys at prior lows, and here's a scale in. Traders use wide stops, confident that the bear breakouts will not result in a bear trend and that they'll reverse fairly soon. The bottoms are rarely ever clear. However, traders have a good sense of approximately where the market will reverse. They know this is a reasonable buy zone, the bottom third of the screen, and they know this is a reasonable sell zone. So traders will start selling either below bars here, here, a second entry short here, or above bars at this high, and then sell more higher. As I said, many traders will buy more lower if the second entry is at least the size of a scalp below the first entry. And the same at the top. They'll sell at a prior high, sell at a prior high, and they'll add on. A lot of traders will add on. Some traders will add on 2 or 3 times and use a wide stop, confident that the bull breakout will fail and that the market will come down to their original entry price, and they'll be able to get out break even on their first entry and with a profit on their later entries. Again, you can scale in. If you do scale in, you have to trade small enough so that the total dollars you stand to lose if your stop is hit are no more than what you would lose on any other trade. And as I said, whenever you scale in, it's usually better to only scale in if the second entry is at least the size of a minimum scalp. I'm going to talk now about breakout mode. In other words, the market is sideways in a trading range, and traders are expecting a breakout. Remember my 80% rule. 80% of trading range breakouts fail, except when the market is in breakout mode. If there's a reason to expect a breakout to occur fairly soon, the probability of a successful breakout is higher. We have a triangle, a series of lower highs and higher lows. So we have a bear trend and a bull trend, and we're getting near the apex of the triangle. I said before, 50% of breakout attempts when you're in breakout mode fail, and we try to get a bear breakout, and then we reversed up. I also said 50% of the time when the market's in breakout mode, the breakout will be a bear breakout. The ultimate successful breakout will be a bear breakout, and 50% of the time, the ultimate successful breakout will be a bull breakout. Here we had a failed bear breakout, happens half the time that the initial breakout fails, and then we ultimately had a successful bull breakout. Lower highs, bear trend, higher lows, bull trend, and the result is a triangle. Again, probability of a failed breakout and a reversal from that breakout, 50%. The probability of a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful, and this first breakout ultimately did succeed. Another trading range, 50% chance of a reversal before reaching a profit target. We had a failed bear breakout, and then we had a failed bull breakout. The bulls see this as a high 2, a double bottom bull flag. The bears see this as a higher high, major trend reversal. Bull trend here, break below the bull trend line by going sideways. An attempt to resume the bull trend that failed and formed a higher high, major trend reversal. I want to talk some about However, traders have a good sense of approximately where the market will come down to their original entry price. Remember my 80% rule. 80% of trading range breakouts fail, except when the market is in breakout mode. If there's a reason to expect a breakout to occur fairly soon, the probability of a successful breakout is higher. We have a triangle, a series of lower highs and higher lows. So we have a bear trend and a bull trend. And we're getting near the apex of the triangle. I said before, 50% of breakout attempts when you're in breakout mode fail, and we try to get a bear breakout, and then we reversed up. I also said 50% of the time when the market's in breakout mode, the breakout will be a bear breakout. The ultimate successful breakout will be a bear breakout, and 50% of the time, the ultimate successful breakout will be a bull breakout. Here we had a failed bear breakout, happens half the time that the initial breakout fails, and then we ultimately had a successful bull breakout. Lower highs, bear trend, higher lows, bull trend, and the result is a triangle. Again, probability of a failed breakout and a reversal from that breakout, 50%. The probability of a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful, and this first breakout ultimately did succeed. Another trading range. %50 chance of a reversal before reaching a profit target. We had a failed bear breakout, and then we had a failed bull breakout. The bulls see this as a high 2, a double bottom bull flag. The bears see this as a higher high major trend reversal. Bull trend here, break below the bull trend line by going sideways. An attempt to resume the bull trend that failed and formed a higher high major trend reversal. I'm going to talk some about second leg traps. I think they're very important. Remember my 80% rule. 80% of trading range breakouts fail, except when the market is in breakout mode. If there's a reason to expect a breakout to occur fairly soon, the probability of a successful breakout is higher. We have a triangle, a series of lower highs and higher lows. So we have a bear trend and a bull trend, and we're getting near the apex of the triangle. I said before, 50% of breakout attempts when you're in breakout mode fail, and we try to get a bear breakout, and then we reverse up. I also said 50% of the time when the market's in breakout mode, the breakout will be a bear breakout. The ultimate successful breakout will be a bear breakout, and 50% of the time, the ultimate successful breakout will be a bull breakout. Here we had a failed bear breakout, happens half the time, yet the initial breakout fails, and then we ultimately had a successful bull breakout. Lower highs, bear trend, higher lows, bull trend, and the result is a triangle. Again, probability of a failed breakout and a reversal from that breakout, 50%. The probability of
What the fuck？ 这个我开始往下。
a successful breakout is 50%.
这跟我玩什么文字游戏啊？80% of the breakout of 80% breakout of the trading range will fail, but like the probability of the successful breakout is 50%. The probability of the fail breakout is有 T8 求解释，这是什么意思 ？Breakout mode， 他说，他说那个什么 Breakout mode 在那个 80% of the breakout mode， T8 求解释 ，T8 求解释，他这个地方他说 80% of the breakout mode，80% of the breakout in the breakout， 那是，好，现在我这边不太懂，T8。求一下解释，他说 80% of the breakout mode， 不对，他说 80% of the trading range the breakout is going to fail， 就是80%它的那个 breakout 会 fail， 但是他这边又说什么 ？The probability of successful breakout is 50%， the probability of the fail breakout and reversal is 50%. What the fuck, bro？ 我这边不太懂，求一下解释。他说 80% of the break，the fuck's going on？Like, what the fuck?
And a reversal from that breakout, 50%. The problem.
Lower high means the bear trend. Lower high means bear trend. High low means the bull trend. 他这一刻我真的搞不懂了。这一刻我真的搞不懂。他说 80% of the trading range breakout fail except the breakout mode。但他这个 breakout mode 的这个 breakout 是 the probability of success of breakout is 50%， 就是他说都是50%，但他要说这个是80%，这我玩文字游戏吗？我真的搞不懂了。这个我真的搞不懂。他说 80% of the trading range breakout fail except the breakout mode。他这个 breakout mode 的这个 breakout 是 the probability of success of breakout is 50%， 就是他说都是50%，但他要说这个是80%，这游戏吗？他这一刻我真的搞不懂。不是， 第八这个我真的搞不太懂。他说这个是80%的整个 breakout， 他在那个 trading range 里面有80%的 breakout 都会失败。他这边说上下都是50%啊。我有一个大大的问题，他说他是80% of the trading range breakout mode fell。But like they got 50% of the breakout mode successful， 进到 breakout mode 之后就 successful。他说我们怎么定义它是 breakout mode？ 大大的问题，他说它是80% of the trading range breakout mode fell。But like they got 50% of the breakout mode successful， 进到 breakout mode 之后就 successful。他说我们怎么定义它是 breakout mode？ 我有一个大大的问题。What the fuck？The range is so tight that breakout likely within the next 5 to 10 bars. But how? How to define the range is too tight? How? What the fuck?
Go to have a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance.
Of course, I know the 50% will be up and 50% of chance of the will be down.
So the first breakout
50% first. The 50% first time breakout will fail. I know that. But like, why? In trading range, it must got like 80% of the breakout.
Here, the bears tried to reverse the first breakout, but they were unsuccessful, and this first breakout ultimately did succeed. 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful. And this first breakout ultimately did succeed. Another trading range, 50% chance of a reversal before reaching a profit target. This first breakout ultimately did succeed. Another trading range, 50%. The ultimate successful breakout will be a bull breakout. Here we had a failed bear breakout, happens half the time that the initial breakout fails, and then we ultimately had a successful bull breakout. Lower highs, bear trend, higher lows, bull trend, and the result is a triangle. Again, probability of a failed breakout and a reversal from that breakout, 50%. The probability of a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful, and this first breakout ultimately did succeed. Another trading range, 50% chance of a reversal before reaching a profit target. We had a failed bear breakout, and then we had a failed bull breakout. The bulls see this as a high two, a double bottom bull flag.
The bulls see this is a high two? Yeah, I know that is high two.
The bears see this as a higher high.
The bear saw this kind of shit is the higher high? Yeah, I know. No, I don't know. The higher high trend reversal because the bull tried to resume the bull trend, and one pullback, two pullback, and we entered this and cannot break up the highest, and then the breakout fell, and then that is the lower high trend reversal. I know.
Major trend reversal. Bull trend here. Break below the bull trend line by going sideways. An attempt to resume the bull trend that failed.
Attempt to resume the bull and it failed. Yeah, I know.
And formed a higher high. Major trend reversal.
Yeah, but how does that even make sense? Like in trading range, you got 80% of the breakout, it might fail. But now you tell me when trend transfer into the breakout mode and you got 50% of the breakout. No, that is even not on the same situation. That is even not a same situation. It means that it got 50% of chance it got to go up, and it got 50% of the chance it got to go down. But like, what the fuck is going on, bitch? That didn't make any kind of that didn't make any fucking thing. Like, that is insane, bro. Like, they got a 50% of the chance it got to go up or down, but like 80% of the breakout it might fail. But like, it also say the first time it got the 50% of the breakout. It got fell. Why? But like why? And it say that the 50% chance of the reversal before you return profit target. So what the fuck is profit target, bitch? You gotta tell me, bro. What the fuck, bro?
I want to talk some about second leg traps. I think they're very important, and they create a major
You gotta be kidding me, bro.
problem for traders starting out.
Okay, so now you use around like 5 minutes to tell me what is breakout mode, but like you and not tell me anything, bro. And you keep going to say the second leg trap, bro. I know what is second leg trap. The second leg trap is because of the training range.
We have a bull channel, maybe a wedge, 1, 2, 3.
Okay.
Complex first leg up. The bears tried to reverse down, but then look what happened. 4 bull bars closing well above their midpoints. 2 of them are very big bars closing at their highs. It looks like this will result in a second leg up. So the first reversal down, bulls probably will buy and will then resume up. I say that without showing the bars on the left. If this is still part of a big trading range, or if it's a part of a big broad bear channel, then the odds of this being a successful breakout are much less. Traders want to see what the follow through looks like.
Yeah, so like the second leg trap is actually in a high time frame. You need to you need to combine the high time frame something and the concept. You need to combining the high time frame concept, and then if that is in the trading range, the 1 1/3 half of the position or whatever, and if that is the on the high position in the trading range, it might fail because the bigger time frame is stronger than the small time frame. So like when we saw something, might be the strong breakout, it might be got the second leg, but like it's still in the high time frame that is just in trading range in the highest position, and it might fail. Yeah, I know that, bitch.
We're getting a bull breakout above the bull channel, and you know
bull breakout above the bull channel, 70% fell within 5 bar. I know. Wait, what? Bull breakout above the bull channel. If that fell.
that 75% of the time, if you have a bull breakout of a bull channel,
you got the bull breakout.
It's going to reverse down within about 5 bars. In fact, if you have a bull or a bear breakout of a bull channel, it'll reverse within about 5 bars.
Yeah, no, I gotta go pee. That is fucking insane, bro. I gotta go pee.
For example, I could draw a line along the bottom, and we have a bear breakout below that channel, and then we reversed up. If this exact breakout was occurring out of a trading range, the odds would be 60% chance we would get a measured move up.
60% up.
But because it's a bull breakout of a bull channel, breakout was reversed up. If this exact breakout was occurring out of a trading range, the odds would be 60% chance.
So the question is the concept. The concept.
We would get a measured move up. But because it's a bull breakout of a bull channel, 75% chance it's going to fail. Remember the market cycle. The trend starts with a breakout, moves on to a channel, and then to a trading range. That's what happens 75% of the time. Only 25% of the time do you get a bull breakout, a bull channel, and then another bull breakout, starting the market cycle over again. So bull breakout, pullback, and then another channel before the trading range begins. Because this is a bull breakout of a bull channel and not a bull breakout of a trading range, 75% chance it's going to fail within about 5 bars. As I said, this is a tight channel. You can call it a complex first leg up, a wedge top. The bears tried to reverse and failed, and now the bulls are again trying, so this is a second leg up. And look what followed. Strong bull breakout, terrible follow through. Probably buyers below. Bulls will probably buy the first reversal down, and they did, but not for a swing. They were scalping out. The bulls who bought this close, disappointed by this. A lot of them bought more, maybe a scalp below, and tried to get out break even at their original entry. And now we have a micro double top and a second failed breakout above the top of the channel. Here's the first failed breakout above the top of the channel, and this is the second one. Most bulls would get out below this bar, and the result is a give up bar here or here, and bears will sell below this bar. Not many bears will sell here after this much strength. Once the breakout fails a second time, a lot of bears will start selling, and this is an example of a second leg trap. Strong second leg, beginners see the 4 bull bars. probability of a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful. And this first breakout ultimately did, because this is a bull breakout of a bull channel and not a bull breakout of a trading range, 75% chance it's going to fail within about 5 bars. As I said, this is a tight channel. You can call it a complex first leg up, a wedge top. The bears tried to reverse and failed. And now the bulls are again trying. So this is a second leg up. And look what followed. Strong bull breakout, terrible follow through. Probably buyers below. Bulls will probably buy the first reversal down, and they did, but not for a swing. They were scalping out. The bulls who bought this close, disappointed by this. A lot of them bought more, maybe a scalp below, and tried to get out break even at the original entry. And now we have a micro double top and a second failed breakout above the top of the channel. Here's the first failed breakout above the top of the channel, and this is the second one. Most bulls would get out below this bar, and the result is a give up bar here or here, and bears will sell below this bar. Not many bears will sell here after this much strength. Once the breakout fails a second time, a lot of bears will start selling. And this is an example of a second leg trap. Strong second leg, beginners see the 4 bull bars, and they believe the market cycle is starting over, and that it's going to lead to a measured move up and a swing up. But they're overlooking the reality that this is a bull breakout above a bull channel. And 75% of the time, you're going to get this, a reversal down to the bottom of the channel. Complex two-legged rally. The first leg was a wedge, and then a reversal attempt, and now another breakout, and then a second reversal attempt. You can also call it a complex top if you want. We tried to top out here, it failed. We tried to resume up, and that failed. This then is the second top. The wedge top is the first. This micro double top is the second. Bulls disappointed by this bear bar. They get out break even here or here, and the bulls that did not give up here. A second entry for a failed breakout of anything is a higher probability trade. And this is a second entry for a failed breakout above a bull channel, and it has a good sell signal bar, and it follows a first entry that also had a good sell signal bar. So this is a higher probability sell. Big up, big down. So big confusion. Big confusion usually means the market's going to go sideways. And it went sideways for about 10 bars. Reasonably strong bear breakout. Probably sellers above, probably the first reversal up, bears will sell it, and then a second leg down. But sometimes the second leg is brief, only a single bar. For example, after this big bull breakout, this was the second leg, just a single bar. At this point, traders are hopeful that this is a bull breakout below this bear channel and that it results in a measuring gap. Maybe they'll look at it as a double bottom, this low, that low, and a bear break below a double bottom. A double bottom is a trading range. A lot of traders are hoping that this is a bear break below the bottom of a trading range. But is it really? we're still above this low. This may be a sell vacuum test to the bottom of a bigger trading range down here. Yes, we've broken below a double bottom. Good for the bears. Big tail on the bottom of the bar. The bars are not all that big. We're still above the bottom of the bull trend. This could be a second leg trap. Again, a complex 2 legs down. This could be the first leg down, and then a pullback, and then a strong second attempt down. You got to watch out. It could fail. The bears hope it's a double top bear flag. So bear trend, double top bear flag. The bears hope it's a failed breakout below a double bottom. But look to the left. We still might be in a trading range. And look at the follow through after the breakout, and then the reversal up at a second bar. At this point, a lot of the bears would be concluding that it's a second leg trap and that we're going to have more trading range price action to the right, which we did. This could be the first leg down. You can say this is the first leg down. All of this is the pullback from the first leg down. You can call it an expanding triangle or trading range. So first leg down, and then a pullback, a complex pullback, and then a second leg down. And the second leg down failed. Trapped traders into selling low in what would possibly be a trading range. Again, we're below the bottom here, and this big tail here, and the bad follow through after bear bars here. Bear, bull, bear, bull, bear, bull. It looks like the bears are taking control, but as soon as they broke below the bottom of this upper range here, they had a big tail here. They tried to resume down. A gap close of this bar below that low immediately reversed up. So these bears are, at this point, really concerned. They look to the left and say, uh-oh, maybe this is not a successful breakout. Maybe this is just the second leg down in a big trading range. Trading ranges are filled with 2-legged moves. One leg up, pull back, second leg up. One leg down, pull back, second leg down. Second leg traps, they always look strong enough so that traders believe the odds are there'll be one more leg up. But instead, you get the reversal. You have to be very careful buying above a bull channel. You have to be very careful selling near the bottom of what appears to be a trading range. The second legs are often stronger than the first. This clearly is stronger than that. This is not really stronger than that, but it's still a fairly strong second leg. Just like 2 legs up here, this second leg is stronger than that first leg. And it's always tricking beginners into believing that it's a successful breakout. It is, of these past 20 bars, but not above the top of the entire range. And the beginners buy here or they buy up here. They sell down here, hoping for the breakout, ignoring the reality that 80% of trading range breakout attempts fail, no matter how strong they are. And very often, the second leg is especially strong, looking like it's going to result in a breakout, but it does not. Bears get trapped into selling low, just like bulls get trapped into buying high. And if you do buy up here, you have to get out, especially a second entry short with bear bars. If you do sell down here, not a very strong breakout, I think you have to get out above this bar, a failed breakout below this double bottom, and a higher low still in this trading range. Again, another second leg trap, 2 legs up. The second leg stronger than the first. Beginners buy, they only see this, and they ignore this. They ignore that we're still within the trading range. Here, you can say this is above that low, and maybe this is the start of a broad bull channel. So we have a higher low, strong second leg up, maybe we'll get a higher high. And it could be. However, it's also possible to be a second leg trap in a trading range. And whenever the market is in the top third of what appears to be a trading range, or what could reasonably be a trading range, I think it's better to look to take profits and begin to look to sell. This is what the bulls are hoping. They have a higher low, and they're hoping that this will be above that, and that we're in a broad bull channel, and they can take profits above that high. However, once you see this, you got to get out. You have to assume it's probably a trading range, especially when it's a second leg, one pullback, 2. Especially when it's a strong second leg followed by a strong bear reversal bar. Strong sell-off, 5 consecutive bars here. Bears are hoping that it's a lower high, and maybe it's the start of a bear trend, and maybe it'll sell off below this low. They want a broad bear channel, but I always assume it's a trading range unless I have strong evidence to believe otherwise. In this video, I talked about how every trading range always contains both a reasonable buy and a reasonable sell setup. I then moved on to breakout mode. When a trading range has gone on long enough and the price action indicates that a breakout is probably going to be happening soon, you have to be prepared for the breakout. 50% chance the first breakout attempt up or down will fail. 50% chance that the profitable final successful breakout. You have to be prepared for the breakout. Breakout mode. When a trading range has gone on long enough and the price action indicates that breakout is probably going to be happening soon, you have to be prepared for the breakout. %50 chance the first break attempt up or down will fail. 50% chance that the profitable final successful breakout will be up, 50% chance it'll be down. And second leg traps, they occur in broad bull and bear channels, and they especially occur in trading ranges. Whenever you see an especially strong second leg up or down, look to the left. Has the breakout gone far above all the bars to the left? Or could it simply be a test of the top or bottom? Bottom of the trading range, in which case you have to assume it's a second leg trap and that it will reverse. So do not buy high and do not sell low unless you're sure the trading range has ended and that a successful breakout is underway. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on trading ranges.
挑战100天内从零，我完全没有学习过的交易系统。不知不觉来到了挑战的第4天。那因为今天是平日哦，所以早上起来的时候呢，我就先把今天的待办事项都先给列出来，然后我就开始学习了。只不过今天学习的时间比较多，所以我没录什么素材。那今天学习的进度呢，是从 breakout 的 15A 到 15F 哦。然后我下午的时候呢，也去运个动，打个球，差不多是这样子。在 Al Brooks 的价格行为里面哦，缺口跟 SMC 的 FEG 他们有点不太一样哦。那有关于缺口这个知识点的笔记呢，我全部都已经整理好了。底下留言缺口，我把我整理超过5个小时的笔记，免费送给大家。我是 Ziro， 我们下次见。
This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on trading ranges. I'll begin by talking about how trading ranges lead to either trend resumption or trend reversal. And next I'll talk about legs. Are they the start of a trend or are they simply a leg within a trading range?
挑战100天内从零开始学习一套我完全没有学习过的交易系统，不知不觉 刚讨论完，脏到要怎么那么脏啊？好冷。那今天呢是挑战的第6天哦。今天早上呢我去台北开会，所以没有在家里学习。不过呢，我随便找了一间学习是没有借口的哦。我随便找一间咖啡厅呢就开始学习啦。那今天的进度呢就是把第16个知识点给全部学完。那学到一个段落之后呢，我就准备去开会啦。那开完会之后也差不多快晚上了，我就找我台北的朋友吃个饭。就让我自己变好人不留恋高的街，忘了照进你的肩膀，是次第一次那个瞬间。哦，就算这个世界不寂寞人家，我会给你怀抱。不到的就来到，的离手。就算这个世界不寂寞的他，我会给你怀抱。聊得非常非常多哦。今天也聊了吃个饭今天也聊了很多，没想到我跟他有这么多的共通点啊。关于单边行情的笔记呢，我也都全部整理好了。底下呢随便留言，我把我整理超过2个小时的笔。我要不退落，哪怕这是什么伤，原来爱情不就是拜拜。今天呢是挑战的第6天哦。今天早上呢，我去台北。拜拜。今天呢是挑战的第6天哦。今天早上呢，我去台北开会，所以没有在家里学习。不过呢，学习是没有借口的哦。随便找一间台北开会，所以没有在家里学习。不过呢，学习是没有借口的哦。随便找一间咖啡厅，学习是没有借口的哦。随便找一间咖啡厅，就开始学习啦。今天的进度呢，就是把第16个知识点给全部学完。学到一个段落之后呢，我就准备去开会啦。开完会之后也差不多快晚上了，我就找我台北好。I'm trying to realize it is alright to not be fine. Now now I'm shaking, drinking all this coffee. 'Cause like you, we can hold roasted. I'm lost in my imagination, and there's one thing I need from you. Can you come through? Yeah. And there's one thing I need from you. Can you come through? Wake up like to do. I'm doing on the first time. Take that matching you.
I'm doing it the first time, walking dream with me. I'm trying silly. Just broke out up KB.
快晚上。
Yeah. I'm trying to realize it's alright to now be fine.
开完会之后也差不多快晚上了，我就找我台北的朋友吃个饭。
Oh, now I'm shaking, drinking all this coffee. Cause I you waking I lost it.
吃饭，今天也聊了很多。我没想到我跟他有这么多的共，要吃个饭。今天也聊了很多。台北的朋友吃个饭今天也聊了很多，没想到我跟他有这么多的共通点啊！关于单边行，
其中一个原因就是我他们现在
聊了很多，没想到我跟他有。
哇，你没看过这种相机吗？它要360度左右。我知道。哇，你没看过这种相机吗？哇，你没看过这种相机吗？
都快晚上了，我就找我台北的朋友吃个饭今天也聊，也差不多快晚上了，我就找我台北的朋友吃个饭今天也聊了很多，没想到今天也聊了。
其中
很多。没想到我跟他今天也聊了很多，没想到我跟他有这么多的共通点啊！关于单边行情的笔记呢，我也都全部整理好了，底下呢随便留言，我把我整理超过2个小时的笔记，全部免费教给大家。那今天呢是挑战的第6天了，今天早上呢我去台北开会，所以没有。那今天呢是挑战的第6天了，今天早上呢我去台北开会，所以没有在家里学习。不过呢学习是没有借口的，随便找一间咖啡厅呢就开始学习啦。今天的进度呢就是把第16个知识点给全部学完，学到一个段落之后呢，我就准备去开会啦。开完会之后也差不多快晚上了，我就找我台北呢，我就准备去开会啦。开完会之后也差不多快晚上了，我就找我台北的朋友吃个饭今天也聊了很多，没想到我跟他有这么多的共通点啊！关于单边行情的笔记呢，我也都关于单边行情我也都全部整理好了，底下呢随便留言，我把我整理超过2个小时的笔记全部免费教给大家。Ziro， 我们下次见。2个小时的笔记全部免费教给大家。Ziro， 我们下次见。
我不想装无所谓，只有的好歹。开始你说的话，是没有人给你回答。一开始装的无所谓。 既爱即时的灌溉，既美即时的陶醉。
那今天呢是挑战的第6天哦。今天早上呢，我去台，
直到我会给你完美。
特别开会，特别开会，所以我在特别开会，所以我特别。
在一个夏天一起飞。
那今天呢是挑战的第6天哦。今天早上呢，我去台北开会，所以我在家里学习。不过呢，学习是没有借口的哦，随便找一间咖啡厅呢就开始学习啦。今天的进度呢就是把第16个知识点给全部学完，学到一个段落之后呢，我就准备去开会啦。开完会之后也差不多快晚上了，我就找我台北的朋友吃个饭。今天也聊了很多，没想到我跟他有这么多的共通点啊。关于单边行情的笔记呢，我也都全部整理好了，底下呢随便留言。我把我整理超过2个小时的笔记全部免费交给大家。我是 Ziro， 我们下次见。
偷偷等待，爱情是这种本事。下个完了，今天第7天，昨天第6天，所以第5天的初稿已经用完了。第6天，所以 number 6，第6天。
Like what the freaking Melly？
爱情是一种本事。哒哒哒哒哒哒哒哒。挑战100天内从0开始学习一套，我完全没有去比想象在安静来变化。我爱是
教练可真够淡定的，科瑞从后场跑过来，CN负责盯防科瑞，然后科瑞在 logo 处停下来，CN 却跑到3分线里面了。他回过头来，科瑞已经接球准备射了，这空位3分也太大了。教练可真巴特勒上篮被桑德斯犯规，然后快艇启用挑战，上显示桑德斯完全打在了巴特勒的小臂上，但裁判给的解释是非违法接触，然后快艇挑战成功。但是对比之前布克这一球，布克是先打到手
今天是挑战第6，不是。那今天呢是挑战的第6天。今天挑战第7天，今天是挑战第7天。我想想啊，挑战第7天，不对啊，第6天，6嘛，对，是第6天。今天是第7天。So actually, I only got that one. Okay, 好。那今天是挑战第7天哦，因为我都在学习，然后今天也花点时间在休息。那今天是挑战第7天啊，因为我今天没拍什么素材，那我们就来讲解一下 K 线的种类吧。在 Albrook 协议的，在 Albrook 的 Price Action 里面 ，K 线的种类呢主要分2种哦。一种呢是有代表趋势力量的趋势 K 线，那另外一种呢是代表没有趋势力量的震荡 K 线。那怎么样子去分别趋势 K 线和震荡 K 线呢？其实就只需要去看一下，那怎么样子去分辨什么叫？那在盘面中呢，你可以把所有的 K 线呢，去把它用2分法定义为趋势 K 线和震荡 K 线。那怎么样子叫做震荡 K 线呢？等一下。잠깐만주세요。那今天是挑战第7天啊，因为我今天没拍什么素材，那我们就来讲解一下 K 线的种类吧。在 Albrook 协议的，在 Albrook 的 Price Action 里面 ，K 线的种类呢主要分2种哦。一种呢是有代表趋势力量的趋势 K 线，那另外一种呢是代表没有趋势。那今天是挑战第7天呢，因为今天没有拍什么素材，那我们就来讲解一下什么叫做，那我们就来讲解一下 K 线的种类吧。那在 Albrook 协议里，在 Albrook 协议的价格行为里面 ，K 线的种类呢，大部分可以。那在价格行为里面呢，所有的 K 线呢都可以分为趋势 K 线和震荡 K 线这2种。那趋势 K 线呢就会代表。趋势 K 线呢，就是代表，今天是挑战第7天啊。那今天是挑战第7天，但因为我没有录什么素材，所以今天呢，我们就来讲讲 K 线的种类吧。在价格行为里面 ，K 线呢，K 线是组成市场的最小单位。在价格行为里面 ，K 线怎么样子啊？那我们就只需要讲一下，这个 K 线就好了。 那今天是挑战第7天，因为我没有录什么。那今天挑战第7天呢，因为我没有录什么素材，所以今天呢，我们就来讲一下在价格行为里面 K 线的种类吧。那 K 线呢，就是组成市场那在 L-Brooks 价格行为里面呢 ，K 线呢，那在 L-Brooks 价格行为里面呢，市场可以把 K 线用2分法来分为趋势 K 线和震荡 K 线。每一根 K 线呢，不是趋势 K 线，它就震荡 K 线哦。那什么叫做趋势 K 线呢？先捱咧。不实操吗？不实操吗？学了一半的搁那实操，给我认真吗？还没学精啊，哥们，还没学精，实操去送钱啊！就是给现在给这，那今天挑战第7天了，因为今天我完全没有录素材呢，所以今天呢，我们就来讲一下 K 线的种类。Demo account. What the fuck is that? What the fuck is that, bro? OK， 今天是挑战的模拟账号，没有那个时间啊，哥们，学习都来不及了，真的没那个时间。先学完，我自己是比较偏向先学习完再去直接打实际的账号，用模拟账号可能比较不太像我的作风。对。OK， 今天是挑战第7天。那因为我今天没有录什么素材了，那我们就来讲讲 L-Brooks 里面的 K 线的种类吧。那 K 线的种类呢？那在价格行为里面呢，你可以把市场所有在价格行为里面呢，你可以把市场的所有 K 线定义为。那在价格行为里面呢，你可以把在市场里面所有的 K 线用2分法来分为趋势 K 线和震荡 K 线。那趋势 K 线呢，顾名思义就是有趋势的 K 线，它就是一根 K 线上下，它就是一根 K 线上下影线比较短。那实体呢相对比较大。再来它收盘呢，的实体至少要是整个高度的一半哦，取决于它是，但这边要取决于它是收阴 K 还是阳 K。那震荡 K 线呢，代表就是多空力量是差不多的。那实体部分通常比较小于整个 K 线的一半哦。那有一些 K 线呢，有些 K 线呢，你其实很难去辨认，它介于两者之间。这时候呢，你就一律当做是趋势。那这时候呢，你就一律当做是趋势 K 线来使用哦。如果你真的不知道，如果有时候呢，你真的不知道怎么样分辨的话，你可以看一下左边的背景，告诉你现在有没有一个明确的趋势哦。那为什么K 线呢？除了是 K 线呢，除了是市场组成最小的一个单位哦，每一根 K 线呢都代表着在那个时空，每一根 K 线呢都代表着在那个时空背景下多空交战的结果。那关于 K 线的种类，的笔记呢，我其实已经列下来了。那关于 K 线的笔记呢？我给他什么？单边行情，然后再什么？
哒哒哒。
Look。好累啊。OK， 今天挑战的来吧，剪吧。OK， 今天是挑战第7天。那因为我今天没有录什么素材了，那我们就来讲讲 Albrooks 里面的 K 线的种类吧。那 K 线的种类呢？对吧？那在价格行为里面呢，你可以把市场所有，那在价格行为，对吧？那在价格行为里面呢，你可以把市场的所有 K 线对吧？你可以把在价格行为里面呢，在价格行为里面呢，你可以，对吧？在价格行为里面呢，你可以把在市场里面所有的 K 线用2分法来分为趋势 K 线和震荡 K 线。那趋势 K 线呢，顾名思义就是有趋势的 K 线。它就是一根 K 线，上下影线比较短，那实体呢相对比较大。再来它收盘呢，的实体至少要是整个高度的一半哦，取决于它。但这边要取决于它是收阴 K 还是阳 K。那震荡 K 线呢，代表就是多空力量是差不多的。那实体部分通常比较小，小于整个 K 线的一半哦。那有些 K 线呢，你其实很难去辨认，它介于两者之间。这时候呢，你就一律当做是趋势。这时候呢，你就一律当做是趋势 K 线来使用哦。如果你真的不知道，如果有时候呢，你真的不知道怎么样分辨的话，你可以看一下左边的背景，告诉你现在有没有一个明确的趋势哦。K 线呢，除了是市场组成最小的一个单位哦，每一根 K 线呢都代表着在那个时空背景下多空交战的结果。那关于 K 线的种类，好了，以上。好啦，那底下留言 K 线，我一样呢，最后一次把我的笔记分享。那一样，底下留言 K 线，我最后一次的吧。那一样，底下留言 K 线，老样子呢，底下留言 K 线，我把我整理超过5个小时的笔记，免费，最后一次的送给大家。我 Ziro， 我们下次见。老样子呢，底下留言 K 线，我帮我整理超过5个小时的笔記，免费，最后一次的送给大家。我 Ziro， 我们下次见。잠깐만주세요，我突然想到啊，应该要怎么样子啊？应该要直接去把这，我记得是第4天还是第5天？这天，我记得这一天。
Very strong breakout in the second leg. We're failing above the high of the channel at the top of this loop channel line, and we're failing within 5 bars, so we continue to go 3 bars and we're reversing down. That's a plausible top.
怎么会睡到绝口不提要幸福？再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。原来我们都一样顽固。来看一下我们昨天的 Rails， 我们昨天 short 到底有多少 ？Oh my god， 1.2K bro， 1.2K，that is quite good， 回调。去 IG 啊，傻逼 ！IG Rails，IG Rails，IG 的 Rails，IG Rails， 影片下方，影片才有机器人应该好。怎么会睡到绝口不提要幸福？再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。
为什么？我哪里在哪里有？
Oh shit, man. It's got like 30 minutes. I gotta cry, bro. I gotta cry, bro. 接受。28分钟，40分钟，35。我操，别闹！我给他10分钟的10分。我并不完美，我需要爱，在我拥有你的时间。我只想你在意，不在乎测想自己到底特不特别。甜蜜的话语，我可以承认，我就是着迷不前，就像是大雁般的春风，我伴着和你见面。哦，有时候控制不住的想你。我早已习惯了的，我想把我的爱封存在想你的一点着，所有代价我都不计，就让我在发疯。生活带给我的你有你全被冲刷。你像个童话出现在我身边，治愈我的痛啊，就是很过分。我想要占有你，你的每一层肌肤都把我给迷住。我承认最爱的那个，不愿说出口。我毋庸置疑我的世界的悸动，你是否和我一样喜欢你说话的方式，像个在世界穿越的装置。我会穿越到与我们的未来，一起那些所谓的 hard time， 我不会被现实给打败。你给我的晚成就我最好的期待。我希望你能够理解。好的 fuck out of PC。
不要解波节，但你不能。
好 PC。有时会控制不住要想你。我早已习惯了的，我想把我的爱封存在想你的一点真，所有代价我都不计，就让我在发疯。生活带给我的你有你全被冲刷，你让像个童话，治愈我的痛啊。我陪你，我想要占有你，我想要占有你，我想要占有你。你说那是你最爱的颜色，说如果没有爱那又如何？怎么了？怎么了？看过你曾经最灿烂的笑容，看过你紧紧拥抱他的面孔，怎么了？你消失了，是不是我错了？搞错了，越爱着，越痛在苦笑着，你走了，都回不去了，像从前快乐，怎么能轻易说要结束？怎么会让你抱着我哭？再努力的我们，最后用力给祝福。祝福我最爱的，能永远飞翔着。原来我们都一样顽固。100分到站。怎么会谁让 都一样冷酷，怎么会谁都绝口不提？再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。原来我们都一样顽固。影片怎么开始？怎么？
为啥？
快高，生活赶着和你见面，只想你在。我给他10分钟的10分。牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。我给他10分钟的10分。我并不完美，我需要爱，在我拥有你的时间。我只想你在，不在乎色，想自己到底特不特别。甜蜜的话语，我可以承认，我就是着迷不前，就像是大雁般的春风，我赶着和你见面。哦，有时控制不住的想你，我早已习惯了等。我想把我的爱封藏在想你的一点着，所有代价我都不计，就让我在发疯。生活带给我的你用你全被冲刷。你像个童话，你用你全被冲刷。你像个童话，出现在我身边，治愈我的痛啊，就是很过分。我想要占有你，你的每一层肌肤都把我给迷住。我承认的最爱的那个，的不愿说出口。我无用指给我的世界的悸动，是否和我一样？再也不能牵着你。再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻才晓得。我给他10分钟的10分。我并不完美，我需要爱，在我拥有你的时间。我只想你在，不在乎色，想自己到底特不特别。甜蜜的话语，我可以承认，我就是着迷不前，就像是大雁般的春风，我赶着和你见面。哦，有时控制不住的想你。我早已习惯了等，我想把我的爱封藏在想你的一点着，所有代价我都不计，就让我在发疯。生活带给我的你用你全被冲刷。你像个童话，出现在我身边，治愈我的痛啊，就是很过分。我想要占有你，你的每一层肌肤都把我给迷住。我承认的最爱的那个，不愿说出口。我想要占有你，你的每一层肌肤都把我给迷住。我承认的最爱的那个，不愿说出口。我无用指给我的世界的悸动，是否和我一样？ 再也不能牵着你走未来，每一步我们怀念什么？失去还那一刻才晓得。我给他10分钟的10分。我并不完美，我需要爱，在我拥有你的时间。我只想你在意，不在乎测想自己到底特不特别。甜蜜的话语，我可以承认，或者是着迷不前，就像是太阳般的春风或伴着和你见面。哦，有时控制不住的想你。我早已习惯了等，我想把我的爱封藏在想你的一点针，所有代价我都不计，就让我在发疯。生活带给我的你用你全被冲刷。你像个童话出现在我身边，治愈我的痛啊，就是很过分。我想要占有你，你的每一层肌肤都把我。
那今天挑战第7天呢，因为没什么素材，也没有什么好跟大家分享的，那我就跟大家分享一下前几天呢读书读到已经。那我就跟大家分享一下前几天呢学习学到快疯掉了这个，那我就跟大家分享一下前几天呢这个学习学到快要疯掉的这个人啊，大家可以小欣赏一下啊。那今天挑战第7天呢，因为没什么素材，也没有什么好跟大家分享的，那我就跟大家分享一下前几天呢读书读到已经，那我就跟大家分享一下前几天呢学习学到快疯掉了这个。今天挑战第7天呢，因为没什么素材，也没有什么好跟大家分享的，那我就跟大家分享一下前几天呢，那我就跟大家分享一下前几天呢这个学习学到快要疯掉的这个人啊。
再也不能牵着你走未来，每一步。我给他10分钟的10分。都不及，就让我在发疯。生活带给我的你用你全被冲刷。你像个童话出现在我身边，治愈我的痛啊，就是很过分。我想要占有你，你的每一层肌肤都把我给迷住。我给他10分钟的10分。不能牵着你走未来，每一步我们怀念什么？失去还那一刻才晓得。我给他10分钟的10分。我并不完美，我需要爱，在我拥有你的时间。我只想你在意，不在乎测想自己到底特不特别。甜蜜的话语，我可以承认，或者是着迷不前，就像是太阳般的春风或伴着和你见面。哦。잠깐만주세요.
This is your friend. Most of your friends. Please stop retained in a fairly parallel channel. Reverse down, 2 points. Start rolling, every parallel, back to the lowest point between, and now you're possible, broad channel. What more to do is sound.
这边只有什么不会，你知道吗？只有扩散通道是不会的。
We're very strongly through it, through the bounce up, and that's the other line. We got near, and we reverse up. In fact, we didn't even follow this up. We have high voltage, now we have double top.
点来汇聚趋势线。
Stick with the bear, possibility here. Reverse down, so I'll start by drawing a line connecting this high and that high.
Too easy 啊 ，too easy。
Possible bear trend.
来，我们再看有没有收看。
And I might later on, we'll see. Right now I'm using this to draw a possible bear channel. Again, two reversals, I draw a line, and I begin to look for possible bear trend in this case, based on the
对，这样子的话就可以画一条趋势通道趋势线。
possible broad bear channel. As soon as I have one line, let's create parallel and drag to the lowest point between to get an idea of what the channel looks like. In general, I'm going to use it for channels that are fairly parallel, so create a parallel to this line and drag it down to the
Easy，我们前面这边就讲过了，这边就讲这里。有没有看？这里先画
点到点，这边一次嘛，这边第二次嘛，然后之后呢，下面虽然刚刚就有一个点，这一点还会出现了，我们就把上面再移下来。然后呢，接下来呢，我们就看，就上面如果几根连上去，5根内1、2、3，3根直接上去，这是这边 Bravo。
Gives me an idea of where possible support might be. If this is a trend, we will down. We will 10 times support at the bottom of the channel. If this is a clear trend, most clear trends, this is support right in a fairly parallel channel.
잠깐만.
Reverse down, so I'll start by drawing a line connecting this high and that high.
Too easy 啊！人啊，
再也不能牵着你的未来。
We'll see. Right now I'm using this to draw a possible clear channel.
easy。
For possible clear trend.
然后我们再看倍数看。
And I might later on. We'll see. Again, two reversals I draw a line, and I use the possible clear trend in this case. Based on
对，这样子的话就可以画一条趋势通道趋势线。
possible clear channel. As soon as I have one line, I'll create parallel and drag the lowest possible clear trend in this case. Based on
对，这样子的话就可以画一条趋势通道趋势线。
possible clear
再也不，
possible
再也。
趋势通道趋势线。
再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻，才晓得。
As soon as I have one line, I'll create parallel and drag the lowest one in between to get an idea of what the channel looks like.
嗯哼。
I'm going to use the channel
嗯哼。
I'm going to use it for channels that are fairly parallel. So create parallel to this line and
我给他10分钟的10分。
drag it down to
easy， 我们前面这边就讲过了，这边就讲这里，有没有看到？这里先画点到点，这边一次嘛，这边第二次嘛，然后之后呢，下面算刚3根直接上去，这是这边3根直接上去。 我给他10分钟的10分，这是这边 Bravo， 这是这边 Bravo。
我并不完美，我需要爱，在我拥有你的时间。我
Too easy 啊 ，Too easy。 挑战第7天呢，因为没什么素材，也没有什么好跟大家分享的，那就跟大家分享一下前几天呢，这个学习学到快要疯掉的这个人啊 ，Too easy 啊，Too easy。 然后我们再看倍数看。 对，这样子的话就可以画一条趋势通道趋势线。
再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻，才晓得。
嗯哼。
还那一刻，才。 失去还那一刻，
嗯哼。
才晓得。
我给他10分钟的10分，这是这边 Bravo。
我并不完美，我需要爱，在我拥有你的时间。
10分钟的10分。
我并不完美，我需要爱，在我拥有你的时间。
这是这边 Bravo。
我只想你在，不再如此问想自己到底特不特别。
Too easy 啊 ，Too easy。 然后我们再看倍数看。 对，这样子的话就可以画一条趋势通道趋势线。
再也不能牵着。
easy 啊 ，Too easy。 然后我们再看倍数看。
再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻，才晓得。
嗯哼。 我给他10分钟的10分。
我并不完
，too easy 啊，too easy。来，我们再看，没收看。
再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻。太想。太小的。
我给他10分钟的10分。
不完美，我需要爱，在我拥有你的时间。
在这边 ，bravo。
我只想你在，不再无私，想自己到底特不特别。
bravo。
我只想。
bravo。
我只想你在，不再无私，想自己到底特不特别。甜蜜的话语，我可以承认，或者是着迷不前，就像是大雁般的春风或伴着和你见面。哦。
那今天挑战第7天呢，因为没什么素材，也没有什么好跟大家分享的，那就跟大家分享一下前几天呢，这个学习学到快要疯掉的这个人啊，too easy 啊，too easy。来，我们再看，没收看。
再也不能牵着你的未来，每一步我们怀念什么？失去还那一刻。太小的。
我给他10分钟的10分。
不完美，我需要爱，在我拥有你的时间。
bravo。
我只想你在，不再无私，想自己到底特不特别。甜蜜的话语，我可以承认，或者是着迷不前，就像是大雁般的春风或伴着和你见面。哦。
那今天呢是挑战的第6天哦。今天早上呢我去台北开会，所以没有在家里学习。不过呢学习是没有借口的哦，我随便找一间咖啡厅呢就开始学习啦。那今天的进度呢就是把第16个知识点给全部学完，学到一个段落之后呢，我就准备去开会啦。那开完会之后也差不多快晚上了，我就找我台北的朋友吃个饭。那今天也聊了很多，没想到我跟他有这么多的共同点啊。那关于单边行情的笔记呢，我也都全部整理好了，底下呢随便留言。我把我整理超过2个小时的笔记全部免费教给大家。我是 Ziro， 我们下次见。 那今天呢是挑战的第6天哦。今天早上呢我去台北开会，所以没有在家里学习。不过呢学习是没有借口的哦，我随便找一间咖啡厅呢就开始学。